about why something hasn't broken, given how quickly rates have risen, given how quickly benchmark yields have risen. Do you see any evidence, either in the economy or in the markets that you track, that shows that something is breaking?
Well, I think the reason something hasn't broken yet is the strength of the cyclical upswing that we've had coming out of the COVID shock has been much more robust than what we've seen historically, especially relative to the last cycle. So with that, you're going to have a higher neutral interest rate. And with a higher neutral interest rate, it'll simply take longer before things start breaking. So you can have more central bank tightening before things fall apart. There also may have been some temporary factors that have held things up this year. There's been a very strange explosion in the fiscal deficit at a time of full employment. That is probably also feeding into the higher for longer strategy on the part of the Fed. So those factors matter, but the critical element here is nominal growth is slowing. Nominal GDP growth is slowing on the back of tighter Fed policy. Gross domestic income in nominal terms, even if you adjust for Fed losses, has essentially decelerated to trend or below trend growth. Here you have the Fed, with policy rates up at 5.25 to 5.5, and they may move up further. So I think in terms of something breaking, that could still be in front of us. There's a perception that we've successfully soft landed, but those kinds of discussions are pretty common prior to business cycle peaks and recessions. So we're not quite out of the woods just yet.
Michael, first day of Q4 primer. What is the signal of disinversion? If 2's10 spread is 100 pre-and basis points and we reverse and we start to disinvert towards normal, what is the signal of that?
Well, you don't get meaningful and sustained disinversions without the front end of the yield curve coming down, which would happen in a slower growth recession scenario with the Fed cutting interest rates. It certainly would be possible, at least theoretically, for the long end to just keep rising in the curve to disinvert. But that's actually pretty unusual historically. The last time we saw anything even close to that was actually 2007. And within a few months, we were actually in one of the longest, deepest recessions in history. So, this inverted yield curve structure backdrop that we have, I think, is a real warning sign in terms of the sustainability of the business cycle. And, I think a bit of cold water in terms of getting too excited about any kind of sustained growth acceleration.
Mike, some real confusion for me, at least at the moment. I hear lots of confidence to why yields can go lower, but I feel that I hear little conviction as to why they're higher. Mike, I don't know how you can make the call for the former without an understanding of the latter. Mike, why are yields up so much at the long end? How much of this is just about budget deficits in Washington?
Yeah, I think a combination of forces, John. Obviously, the economy has been more resilient than anticipated this year. And you do have this strange fiscal policy environment where the fiscal deficits exploded to levels really never seen outside of wartime when you're at full employment. And so the Fed's higher for longer strategy has been self-actualized by the bond market. We can see them move up in real yields is going basically step for step with that 36-month Fed fund futures implied yield. So that's the higher for longer trade. But that can also be unwound. This has happened over the course of this year, over the last 6 months, really. And with softer data going forward, that trade can be unwound. So I think we know why it's happening. The question is, what is the forecast going forward, and will that forecast be accurate?
Mike, thanks for the insight, buddy. As always, Mike Downer there of Roth MKM on this bond market. Yields aren't falling this morning, that's for sure. They're up 6 basis points, 463, 30-year up 4 basis points. Your 30-year yield, 474. Curious, isn't it, Bramo, that you get that post-shutdown averted pop in equities and it fades, and then you get that post-shutdown averted pop in yields and it doesn't fade at all. It sticks.
Is good news bad news? I don't want to say it because I'm going to get eviscerated, but that's exactly where we're heading. Yeah, that's basically what we're looking at right now.
That's what Matt Gaetz is going to say to Joe Matthew this afternoon.
What, good news
Joe,
or
it's
bad
good
news?
news, bad news.
Jordan Rochester, Nomura on foreign exchange up next on why he thinks this euro can get closer and closer to parity against the US dollar. That's next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
It sort of just throws us back to the biggest driver of all, which is this huge rise in treasury yields as the vigilantes take over, because the one thing that's not going to stop is treasury issuance. We're going to have to find the clearing price for all these bonds and notes. And if the next place we go is 460 on a 475 on a 10-year note, then the dollar's going up.
Dollar's going up right now. Kit Jukes, SocGen, let's check out the market for you. The euro, 11 weeks of weakness against a stronger dollar. Right now, euro dollar about 105, 105.41. That currency pair negative by 0.3%. Jordan Rochester of Nomura calling for euro dollar to hit 102 by year end with, quote, the potential to reach parity if energy prices continue to climb. Looking out to 2024, here's the view. We expect Fed cuts to provide euro with some relief, allowing it to climb back towards 110. So we're somewhere in between, Tom, right now. At 105, what's next? Parity, or are we going back to 110? Jordan thinks we get closer to parity before we look up.
This is the real world where it's not pontificating big figure moves. It's about actually putting capital at risk and having a trading ban and measuring the support and the resistance of any given trading band, whether it's euro. Joining us now, Jordan Rochester, G10 FX strategist at Nomura. What I see, Jordan, this morning that is absolutely distinct is finally Swiss franc gives way to stronger Swiss franc. It's ever so slight, but that's a distinctive tea leaf. Link euro trajectory with the symbolism of a stronger Swiss franc to come.
Indeed, Tom. I think last week's weakness in Swiss franc was a lot to do with month end as well. A lot of moves last week were to do with that month end flow because of the equity sell-off that we had. But when it comes to the sort of view on Swiss and Stocky and all those sort of local euro area currencies, Swiss is one of those currencies where, in a global slowdown, it tends to strengthen. It's still got a banking repatriation flow as well. So if you think the euro area is going into a recession, which we do, that is usually to the Swiss franc's benefit. You've still got a central bank that is also intervening in the FX market as well. 11 billion euros per month of FX intervention to strengthen their currency. So even though we think the S&P is done with rate hikes, because of the impending global slowdown, the potential for recession risks pretty much in Europe and the US, it's very hard to be selling the Swiss franc.
Okay, sell Swiss franc, I'll go with that, but then I got the euro. What is the appropriate pair to play weaker euro?
Well, we're looking at it this morning. I mean, the view for us is euro dollar and euro CAD. I think euro dollar towards 102 towards parity is very possible as long as oil prices don't find a way to collapse. In the previous guest you had on, Kit Jukes, he was talking about US yields rising higher. Well, US rates suggest that euro dollar should be at 101 to 103 already. And if oil gets to $100 a barrel to $110 a barrel, it's very easy for the euro area to see their currency weaker because they are an energy importer. The problem for all of us this year in euro, as the chart shows you, it's been a zigzag, up, down, up, down, up, down. And this looks to be finally an exit of that range-bound price action. This looks to me more like a trend now. It's a bit of deja vu to last year. Last year, euro broke through parity thanks to Vladimir Putin, natural gas supplies being squeezed. This year, it's more thanks to what's going on in the Middle East with the lack of oil supply, and that's going to help the euro get towards those sort of figures. The main risk is if the US data starts to come in soft and US yields stop climbing. But I think we've had a bit of good luck in that respect for this week at least. US government shutdown's been avoided, which means that we're going to get non-farm payrolls, we're going to get the JOLTS data, and crucially, we're not going to get all those government workers laid off. It was going to be really difficult for the market to buy the dollar with initial claims, jobless claims, spiking higher on Thursday. Well, that shouldn't happen now, thanks to that government shutdown being avoided.
Jordan, we've got a natural bias here to ask questions about the US dollar, US rates, Federal Reserve, the US economy. You touched on the international story. Can you help us understand how important that is? Not just what's happening with the Middle East and crude, but also what's happened or hasn't happened over in China.
Absolutely. Well, the situation in China has been that for the first half of this year, most economists were quite disappointed with the growth data. We've had a more bearish outlook on China than most when it comes to our GDP forecast. But what's happened over the summer is that China has done little bits of policy here and there, and it's kind of built up to a much more mixed view in the market on China, which is China slowing down or is it bouncing back? And the property measures, such as cutting mortgage rates for first-time buyers, is a significant one because most of the Chinese property market is first-time buyers. Well, that's going to lead to some of the Chinese data looking healthier over the short term. But for us, the long term is that China's trade balance, China's current account, those flows are looking pretty weak, especially with the tourism outflows, which are going to continue to pick up. So from a flow perspective, we're not seeing the inflows into China bonds like we saw from foreign investors either. Altogether, weaker outlook for China, a bit messy in the short term for data surprises because of all of these sort of measures that were announced. But the big picture is a slowdown and a weaker renminbi for us.
Does that make it more difficult to make a call for next year that goes beyond 110?
Well, the difficulty with the euro-dollar view is that when the Fed cuts rates, when you get liquidity, it leads to dollar weakness. Now, we have the view that the Fed could even cut rates as soon as March because of a recession call that the US economics team at Nomura have. That starts in Q4, by the way. But if they're wrong, if we get an actual soft landing for the next few months, because soft landings can last a few months before it turns into a hard landing. If we have all the data in the US pretty healthy in Q4, it pushes those Fed cuts out. So that 110 call is based on a Q1 story next year, really, where the market quickly shifts to saying, yep, Fed cuts are coming in the next few meetings. At the moment, we're in the higher for longer phase. That's why the dollar's not selling off here.
Jordan, one reason why I love your research is because you always put this sort of conviction level that you have on each trade. Can you talk about how difficult it is to have conviction at a moment where you're dealing with so many variables? We're tracking the weather again. We're tracking, different congestion pricing and congestion emissions over in China to understand the recovery. I mean, how do you have conviction in a market like this?
You have to look at the local stories, I think. So you have the broad dollar view, which we've got a pretty high conviction on, 3 to 4 out of 5, I would say. For the long dollar view. Then the local story, and what helps me, Lisa, is positioning. So just a few weeks ago, maybe let's go back 4 weeks ago, you would have had guests on here saying the Bank of England could raise rates maybe to 7%. And because of 1 week services CPI and one Bank of England meeting and a weak labour report as well, it's quickly shifted to the Bank of England's done. And because of that shift in narrative, you've got a lot of stale positioning out there. So I think in sterling, there's still a long sterling position amongst some investors that needs to be unwound. We've gone through a lot of that already, but I think there's more to go. So that helps me have a 4 out of 5 on short cable, for example. Or then you have to look at the other factors in Asia and elsewhere and think, where is there less positioning? I think that's where you have lower conviction. So if there's less positioning, less of a positioning squeeze, there's not much of a trade to do. But short cable, short euro, I think there's still some stale longs out there that need to be unwound.
Jordan, this is a pretty toxic recipe for the Bank of England and for the European Central Bank, right, with inflation?
Well, inflation's coming down. The main thing is, does it not fall to 2%? And that's what the central banks are really worried about. I personally look at all these charts that help us forecast inflation, and it looks like it's going even below 2% on some of them. So PPI, which is the manufacturing inflation in the UK and Europe, it's pretty awful. I think in Norway, it's minus 35% year on year. So you get these extremes in manufacturing that will push the headline down eventually. So I think, look, we could be looking at CPI falling much closer to 2% than central banks think.
And then, Lisa, we'll be looking at global recession risks in the early part of next year. And a lot of these central banks that are worried about inflation today will be very worried about growth and employment tomorrow. We've already got signs in the UK labour data, the Swedish labour data. There's layoffs happening. And when we get to the year end, I think a lot of central banks will be changing their focus on inflation was high today and focusing more on the fact that it's going to be quite low tomorrow. The main risk to that, of course, is oil and the supply side. So in the US, these UAW strikes are boosting car prices. And as we know, the oil market's moving headline inflation higher as well. If we have another rise in oil to 110 per barrel, then inflation will be, the central banks will be in a stagflationary mode, and the markets won't like it. FX will be selling those sort of currencies like the pound, like the Swedish krona, because that's what the sort of mix we had in 2022. So we could be going back to a 22 style FX market reaction, which was massive dollar strength.
Well, 20 seconds for you, Jordan. You can have it. When was the last time Villa scored 6 goals?
I can't remember. That's a good stat, but it's bloody good, isn't it?
It's bloody good, Tom. Do you hear that?
It was a
Rochester.
proper game.
Jordan's words. Not
I practiced all weekend proper.
Jordan Rochester and Murray. Jordan, thank you.
It was proper.
It was proper what?
It was a proper game.
It's a proper game.
Yeah, it was a proper game.
Tons of goals. You like that?
I do like it. I watched
Now, if
Liverpool.
each goal was worth 7 points, you'd really like that,
Well, that's,
wouldn't you?
yeah, that's true.
Stop throwing shade at U.S. football. Come on. That's ridiculous.
Wouldn't that make a difference? Wouldn't that make a difference?
Okay, let's get it out of the way.
Sports tackling.
It's a new soundtrack. I could dance to this beat.
Just on the
The
field
lights
so
are
much, it's
so bright,
overwhelming.
but they never blame me. Welcome to New York. Welcome to New York.
Enough with the shade. Okay.
Mohammed from Cambridge emailed, says, why haven't you brought up the Jets top of the show?
I'm surprised he wants us to talk about the Jets. Didn't they lose?
You know, Taylor made an appearance.
Better
Life
than the
is
Mets.
good. You know,
That's
there's a
basically
glow.
the reason why.
I've heard that there's complaints about these sort of switch to, you know, the camera switches to Taylor's reactions all the time. The reaction cam, that people don't want it.
Yeah. Well, who's people?
Like football fans.
Right,
don't want
not the switches.
it. Precisely.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
U.S. We see inflation cooling. We see the economy slowing.
Disinflation, it has been very consistent.
The transmission of higher rates really didn't flow through with the normal 4 to 6 quarter lag that we were expecting.
I think we're seeing the beginnings of an unraveling.
We continue to think that the Fed is at a peak. We also continue to think that the Fed is going to be cutting interest rates next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market pop didn't last that long. We are totally unchanged on the S&P 500. Crisis averted, avoided, TK, at least for now.
Yeah, widely predicted. I think our Washington coverage has been great on this. Some real humility about, don't do this theory, that theory, the other, but what a shock. 3 hours before whatever it was, he did a John Boehner and got the Democrat vote. It's something we've talked about here a lot.
We can do it all over again over the next month into November 17th.
It's just,
Anne-Marie coming up in about 15 minutes. She'll bore you with that. Then Congressman French Hill, lots to talk about leadership in the House a little bit later. French Hill, 7:45 Eastern Time.
I looked at the votes in the Washington Post, all laid out, and the first one I went to see what the gentleman from Arkansas did. I knew what he would do, but sure. I actually went to see what French Hill's vote was.
We'll catch up with French a little bit later. 165, the estimate for Friday. Bramo, tons of data this week. Chairman Powell coming up as well. But 165, the estimate against 187 the previous month.
So we're actually going to get data. That is the headline, really, that we are going to get the data that we had been previously expecting, and that it basically opens the door to a greater potential for a November rate hike. This is from Andrew Hollenhorst, who has been calling for that anyway. But that seems to be what's playing out in markets. The fact that we're going to get data that confirms ongoing strength, albeit at a slower pace, but still solid labor market, will allow the Fed to keep going further and keep rates higher for longer. That's why I said good news might be bad news. And I know people are going to be like, oh my God, we hate this phrase. And I agree with you. But at the same time, that seems to be what's playing out in markets.
And then we can move on to earnings, October 13th, JP Morgan, just 2 Fridays away. That's just around the corner as well. As we kick off Q4 and wave good riddance, not goodbye, to Q3, your equity market looks like this on the S&P. Equity futures are just about positive by 0.04% after a quarterly loss, a monthly loss, and a 4th week of losses on the S&P. Yields are higher through 3Q by more than 70 basis points. This morning up 6. TK, your 10-year, 462.89.
Again, I'm watching the far out the yield curve is well. It's sort of a jumble. Like you said, we were up on the equities, we give it back. But as we talked to Jordan Rochester about, I'm forced today to look at little itty-bitty tea leaves, and what I notice is stronger Swiss franc. You really wonder what that means as a signal for euro weakness.
Tally up the weeks, 11 weeks of that. Bramo, can you imagine 12 weeks of euro weakness? We've had 11. Can we make it 12? The euro right now at about 105 against the dollar.
Jordan Rochester says yes, because what's going to actually drive it stronger, especially in light of the fact that we're now all watching the weather again to see whether oil prices go up. Here's what I'm watching in terms of the data. At 10 a.m., we get U.S. ISM manufacturing as well as the prices paid for that component. We have been in recession, in a contractionary phase for manufacturing since October of last year. We are inflecting upward. That inflection is interesting to me at a time where people are wondering, where are the nodes of inflation reacceleration? Could it come from the manufacturing sector that has been in recession? At 10 a.m., JP Morgan CEO Jamie Dimon is speaking with Bloomberg's very own Emily Chang in London at the JP Morgan Techstars Forum. It is going to be interesting whether he reiterates either strength. Does he go to 8% projection on 10-year yields, or does he talk about the fact that we end up, in a situation where the consumer is slowing down? And today, this is for you, Tom. Fed speak. Let's go through it. It's 11 a.m.
I think it's legit.
It is legit Fed speak. It's 11 a.m. Fed Chair Jay Powell and Philadelphia Fed President Patrick Harker both speaking in York, Pennsylvania. 1:30 p.m. we get New York Fed President John Williams. He will be speaking in New York City. This is not the same speech, I believe, as the one that he was supposed to deliver at Long Island. Well, thank you, Tom, for that. And then at 7:30 p.m., Cleveland Fed President Loretta Mester will be speaking. We are at a point where it is very difficult to have any clarity. And John, I have to wonder at what point the Fed speak adds to that at this point, because as you've been mentioning, no one said anything about Jay Powell's discussion last week. And I understand he was talking to a community forum,
Sure.
student educators or whatever. But the point being here is that they don't really have much to say.
10-6, 10-12.
What's that?
10-13, 11-1. Those are my 4 data points of October out to the November 1 Fed meeting. That's all that matters.
Let me guess, is that payroll, CPI, and JP Morgan?
Yes.
Okay.
It's
I'm here to translate.
all that matters.
They're the dates.
That's
Okay.
everything else is toxic brew of stew.
Bramo, I'm trying.
It's like a crossword puzzle.
My heart.
It is.
Been doing this a long time.
Are you good at crossword puzzles?
Just translate
It depends.
I'm like the worst.
It
I'm like
depends.
the absolute worst.
Monday.
I hate
Sam
it.
Stover, he's good at crossword puzzles, eh? Chief Investment Strategist at CFRA, joins us now. Sam, explain this one for me. What is a counter-trend rally, and why are you looking for one?
Good morning, Jonathan. Counter trend rally. Well, I think basically there's been too much pessimism in the market in the short term, looking at such factors as the relative strength index, stochastics. I guess taking it from a technical perspective says, you know, we've pushed the balloon too far underwater, and now it has to pop, at least in the near term, based on possibly the reversal of yields right now, the continuing decline in the employment numbers and rise in the unemployment.
Right.
So basically saying that as we head into Q4, we could end up with a bit of Q-phoria.
Sam, well, the Q-phoria is, it's cute. Should we steal that? Let's make a decision now. Let's take a meeting.
Don't steamroll over that. You've got to sit on that. Q-phoria.
Q-phoria. We're going to steal on that. I'm going to go to Don McLean. Forget about American Pie. Let's do Vincent. You're acclaimed for your stars. How have your stars changed? 4- and 5-star dynamic, Sam, into the fourth quarter. If it's starry fourth quarter, what's it going to be at CFRA?
Well, our analysts are out of this world, but I would certainly say that the stars have not changed all that much, which I think is a good indication. When you look to relative strength on a short-term and on a longer-term basis, we're still showing strength in those growth areas: communication services, consumer discretionary, technology, and to a lesser extent, energy. And so our stars continue to show a greater percentage of the coverage gravitating toward those areas. So I think that we are going to see a recovery in the fourth quarter of this year, and those groups that led the way in the first half will continue to shine in this final quarter.
I can't say enough, Lisa, that is the S&P CFRA and frankly Bloomberg Intelligence way. But damn the short-term BS. Look at the long-term, and those stars show stability of revenue down the income statement to earnings of all the different sectors.
Gloria Cavacina said that it's very hard to see the stars right now because we are such a muddied, we're in such a muddied position when it comes to the economic cycle. Sam, how predicated is Q-phoria on rates going lower?
Well, I think that's just part of the overall equation. I mean, historically, if you go back to World War II, every pre-election fourth quarter of third-term presidents have seen a positive total return, with the average gain being around 6%. We've seen those sectors that have been the outperformers being in the technology, materials, and industrial space, whereas utilities, real estate have been among the underperformers. So I think that investors basically are going to start to look toward the end of 2024. They're going to give up on looking to the end of 23, and anything that far out in the future, myself included, looks an awful lot better.
Just to put a bow on this, are you saying that basically we've seen the lows in tech prices?
I think that we have seen a near-term low in tech prices. I wouldn't necessarily say that the shakeout has totally run its course. I'm still looking for a test of the 4,200 level on the S&P 500. That would bring it down to about 8.5% pullback since the July 31 high, and NASDAQ probably could end up being a double-digit decline before all is said and done. But I think that would represent a better buying opportunity as we move into 2024.
Sam, I'm focused on the banks. Give me your treatment of a Q4 recovery in the banks. The technical chart is ugly.
Well, the banks, sure, when you're looking at the mainly the regional banks continue to look pretty bad. Also, you find that the diversified banks are having their challenges. But if you look to financials, this third quarter, financials are expected to narrow their loss from a 6% decline in earnings last quarter to a 0.3% shortfall this quarter. And if you realize that 54 of the last 56 quarters have seen actual results exceed end of quarter estimates, I would tend to say we might end up chalking up one more in this third quarter and actually go from an earnings recession back into an earnings expansion.
Sam, do banks need higher yields or lower yields?
Well, the higher yields give them greater net interest income, but I think also it ends up causing them to be more restrictive on their lending policy. So I really would rather that they end up having more of a flat to softening interest rate environment, because then also you would see less of a increasing threat of recession and a greater likelihood of a soft landing.
Hasn't benefited those stocks this year at all. Sam, thank you, sir. Sam Stovall there of CFRA, navigating the stars under cloudy skies. That was Chairman Powell, wasn't it? Jackson Hole. Speaking of Jackson Hole, Patrick Harker, caught up with Patrick Harker of the Philadelphia Fed. I always think audience matters. Lisa talked about Chairman Powell sitting down with Patrick Harker to participate in a roundtable discussion with workers, small business owners, and community leaders. Now, Patrick Harker talked about anecdotal evidence of a slowdown. I wonder if they received that anecdotal evidence today.
I would guess that they will, because what you can see is in the data, you have seen small business bankruptcies tick up pretty dramatically. A significant portion, basically 3/4 of all small business owners, are saying that their business is being hampered, is being hurt by rates where they are. So that's the view that they're going to be hearing. The fact that they're leaning into that, does that give you a sense of a sort of more dovish inclination of a Fed?
Are those businesses going to say, you've done enough, and start banging the table, TK?
They're going to bang the table, and they're going to think it's going to be about capitalism. You know, back when I had my first pair of Boston Birkenstocks, you know,
Cannot see you in Birkenstocks.
I'm in
Really
the record
cannot.
store in Amherst, Mass, and it's like a complete lineup of bootleg Grateful Dead records. Doug Cass has them all. And you're looking there, did I ever think Birkenstock would pop out with an LVMH private equity? Can you see me wearing my Birkenstock Bostons into Tiffany's?
Do you still have some Birkenstocks?
I have 3 or 4 pair, yes. I have the old pair. I don't wear them. They're up top.
With
My feet
socks
have
or without
changed.
socks?
Well, now with socks. Darda wears them with socks. If Darda wears them with socks, I'm wearing my Birkenstocks with socks.
We're putting the IPO price up on the screen for those of you listening on radio.
This
the
is
IPO price,
anti-American.
$44 to $49. We've got this chat with our producers who are screaming, "Someone say the news," which seems to be seems to sum up this program pretty well.
The news, madame.
Why are we talking about Birkenstocks?
We're talking. No, this is our no. Seriously, John, we're talking about them because it's been a private German company since the time of George Washington, picked up by Arnault. Private equity, private, you know, Catterton or something, LVMH deal, and they're Louis Vuittoning Birkenstocks. That's un-American.
People at home just screaming, "Someone say the news." If you're just tuning in, welcome. I hope you're still with us. Equity futures totally unchanged. We're negative now by just 0.01%. Coming up a little bit later in the next hour, David Leibovitz of JP Morgan Asset Management. Lots to look forward to this week. Pushing ahead to payrolls on Friday. Tons of Fed speak through today and through the week as well. The ISM on manufacturing and ADP report, jobless claims on Thursday. Lisa, a lot to get your hands around, and I'm with you. If we had a shutdown, there was a real risk, the potential that we wouldn't get the payrolls report on Friday. Then all the emphasis would get put on earnings. It's pretty good to get that news a little bit later.
It is pretty good when it comes to clarity, maybe, but is it going to necessarily create this feeling that the Fed's going to hike rates in November? Because if things come in pretty well, then the Fed can't sort of shift the sort of more dovish feel that they might be getting from some of these small business owners.
Do you like the wool felt Birkenstocks, or do you like the leather ones?
I like the leather ones.
The leather ones?
Yeah, yeah.
The leather ones are more brand.
Just against sandals.
I have.
Sandals.
Well, the Bostons aren't sandals, though.
Sure, that's fine.
Okay.
Yeah, that's fine. But in New York City, absolutely not.
Come on, John, I can see wool felt Bostons.
Absolutely
you look great.
no chance.
They're no, they have you can hide your ugly
What
toes.
about like nice sandals?
No, in the city, absolutely not.
Why not?
No.
What if it's hot? It gets hot. It gets sticky. What do you do?
Was that a road show?
You wear sandals with socks, apparently. What's that about?
Can you imagine the merch at the Birkenstock road show?
trillion industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
I do intend to file a motion to vacate against Speaker McCarthy this week. I think we need to rip off the Band-Aid. I think we need to move on with new leadership that can be trustworthy.
I'll survive. You know, this is personal with Matt. Matt voted against the most conservative ability to protect our border, secure our border. He's more interested in securing TV interviews than doing something.
It feels personal. Congressman Matt Gaetz there, House Speaker Kevin McCarthy on the Sunday shows. Mr. Gaetz, Congressman Gaetz catching up with Bloomberg's Anne-Marie Jo Matthew later on Balance of Power, 5 p.m. Eastern Time. Do not miss that conversation. If you are just joining us, welcome to the program. Your equity market on the S&P 500, almost totally unchanged this morning. No pop post that government shutdown averted news over the weekend. Equities positive here by just 0.02%. Yields are higher, though, by let's call it 5 basis points on a 10-year TK. 462.48.
Watching the data here, and again, John, in the ISM, what is it, Lisa? 10 o'clock this morning, 10 a.m. We're going to get this important John Farrow data. I agree it's important, but all of a sudden we get data dependency wrapped around, 18 Fed speakers today. It's an eventful Monday.
Everyone's writing in, Tom, my favorite TK shoes, the leopard print Doc Martens, which exist,
wore
by
them
the way.
yesterday, actually. They're really comfortable.
They exist.
No, why do I wear them? Want to know the truth?
Please share. Why do you wear them?
Instead of having to wear old fart, shoes that look ugly as sin, Doc Marten makes some very nice shoes where, when I have the walker or the dogs, I can stay stable.
It's that or the Prada sneakers.
Yeah, well, the Prada, that's different. That's like for, the work and all that. But the Doc Martens work, but the Birkenstocks don't work. I just, I used to wear them a lot. And, the wool ones.
I still can't picture that. How do you get stability in something like that?
John.
Where do you find stability?
John, clogs.
I wore clogs.
The wooden clogs.
I wore those. Yeah, in high school.
In a serious way.
Yes. Yeah.
Not ironically. No.
Let's move on.
Right now, we're going to get saved by Emery Horton. We're going to do the serious stuff. We're going to do the serious stuff first. We'll get back to AMH, our IPO reporter, here in a moment. She's our Bloomberg I Worked All Weekend correspondent. A really important moment for Balance of Power tonight, Anne-Marie Horton, your conversation with a gentleman from Florida. What is the relationship of Mr. Gaetz with the leader of his crew, Mr. Trump? I'm fascinated by Trump DeSantis and different Trump Gaetz.
Well, he's Matt Gaetz, the congressman from Florida, is self-described as the, quote, Trumpiest congressman. So I think that tells you a lot about where his allegiance lies and also how he likes to really, fashion himself on Capitol Hill. He wants to be extreme. He definitely does like a lot of attention. As Speaker McCarthy said in that interview, he's about securing television interviews. He wants to get his message out. And that message is this week is that he is going to file that motion to vacate. The big question for him is, does Matt Gaetz have the votes? Does he have some Republican support he will need on top of the Democrats who you would think, vote to oust Speaker McCarthy, but that's a little bit unsure at the moment. That's the big question for him.
Well, he's secured another interview, hasn't he, Anne-Marie, a little bit later, 5 p.m. Eastern time. What's the focus of that conversation going to be for you?
I think it has to be if he has the votes, Jonathan, but also really what's his aim here? Because he did vote against one of the most conservative stopgap funding measures, a resolution that would have cut the federal spending at 30%. And now what you see is a stopgap resolution, the government's still open till November 17th, but at the same spending levels. So he could have had a more conservative agenda had he voted for that, and he didn't. And at the same time, he did vote for continuing resolutions under the Trump administration. So why is this an issue for him now?
Economics, the efficient allocation of resources, time. Anne-Marie, typically, if there's a story that I don't feel like I need to pay attention to, I won't pay attention to it. Will the outcome of November 17th be any different to the outcome over the weekend? Is this a story I can ignore between now and then?
Well, it depends how much work gets done, right? They still have to finish these 12 appropriation bills. The House is further along than the Senate, but then they also have to come to conference because the Senate bills that it's run by Democrats is going to look very different than the conservative bills, which is run by Republicans in the House, and cannot get done before November 17th. At the same time, how much more difficult is that situation going to be to get done? 12 appropriation bills at the same time. Potentially, we might have another speaker vote. Remember the last speaker vote in January? That was 15 rounds. Now, not saying that this is going to go anywhere with Congressman Gates. There is a potential path for Speaker McCarthy to maintain his position, but this is going to cause a lot of chaos, and it's going to be a huge distraction.
Well, does the path for McCarthy to be sort of confirmed as Speaker and to beat the vote that Matt Gaetz is bringing to the floor, is that path include making concessions to Democrats?
Possibly. I mean, what you've heard from so far, whether it's Catherine Clark, she was saying how the whole conference, the Democratic conference, needs to discuss what their path forward is. Potentially, no one will actually have to vote for Speaker McCarthy, but they could either not show up or vote present so that he would have enough of the Republicans that do want him to maintain that position, which is the majority, that can keep him in that job. But then you're looking at almost, a dual-run conference, because if he's going to need the Democrat support, he's likely going to have to give something up for that.
Is Matt Gaetz gaining in popularity as he does this?
I think his name ID, his name recognition is certainly going up. This is someone who really only went on conservative media. Look, he was on ABC this week. He was on CNN. He's coming on Bloomberg this evening. And there's a lot of reporting that he's actually eyeing to run for governor in Florida. He denies that and said he's focused on getting former President Donald Trump elected. But if he's looking to run for governor of Florida, he is certainly getting his name ID up, not just in Florida, but also nationally.
And also joining us this morning, our IPO correspondent.
And he's campaigning on it.
Yeah, okay. Well, joining us now, our IPO correspondent,
Anne-Marie
Harder. And Anne-Marie, I got to ask you about, I know you and I were talking last time we saw each other about the Dior Birkenstocks. They're $120. Dior does a collab. They do a Savoir Faire collab and pop these puppies out with Birkenstock to $1,100. They scream AMH. Would you be caught dead on those, Anne-Marie Horton, the Tokyo Mule Dior by Birkenstock collab?
No, just because I was looking at the photo there, just because it's Dior or Miu Miu or Manolo Blahnik, I'm a hard no on Birkenstocks.
So there we go.
No,
I mean,
there you go.
But John, you've led on this seriously.
Oh, I've been leading our coverage worldwide, yeah.
No, come on. Luxury has cratered, right? In Q3, luxury cratered,
I didn't
right?
even bring this up. There was some weakness
I'm
based
also
on what we
hard
heard
no
from a
on
couple of
Crocs.
companies, likes of Richemont.
Yeah.
We're talking about North American weakness.
Yeah.
There was a hope that reopening some of the travel from China would bring the tourists back to the United States and boost North American luxury spend, but I'm not sure it's happening in quite the same way.
Forget about the jokes about Birkenstock. The fact is, here's a private family company back to George Washington that LVMH is capitalizing. I mean, I don't know, is the price that they announced this morning a big deal? I don't know. But it's just amazing. I didn't go to the roadshow like you did. And I'm fascinated by what LVMH is doing there.
What's going on?
Are we?
Let's
it's a
go
serious
buy
conversation
Birkenstock.
we can have away from Birkenstock. I do think this issue around the budget deficit in the Treasury market is absolutely massive. I really do. And I think there's this intellectual standpoint whereby you just stick with the old sort of school of thought, which is it doesn't matter, it's never mattered. The fact they're not taking it seriously in Washington, they're really not taking this seriously at all in D.C.
And Lisa, this is critical to our conversation last week with Maya McGinnis.
Well, we're dealing with a situation where we did not term out our debt the way that a lot of consumers did. The United States has to refinance at the current rates, and that means interest payments go through the roof at a time where the total deficit is also going through the roof.
I have to admit, I'm watching interest payments of the government. Peter Orszag taught me that years ago when he was head of Congressional Budget Office.
The reason consumer balance sheets are strong is because the sovereign balance sheet isn't. That's the story of the last 3 years. AMH, thank you. Looking forward to the conversation a little bit later. 5 p.m. Eastern Time, special edition of Balance of Power live from Capitol Hill with Bloomberg's Anne-Marie and Joe Matthew. Live from New York. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Conversation and commercial break totally out of control.
We got to do Big Lou. I've said it.
Oh, I could go.
Bramo Cam.
Yeah, well.
We've got to take that live.
You also had some revealing moments. That's all I can say.
Sure, okay. Not as revealing. Equities on the S&P. unchanged. Let's call it positive, not even a tenth of 1%, up by 0.06%. On the NASDAQ, up by 0.25%. On the S&P last month, down on the month. Last week, down on the week. Last quarter, down on the quarter. Biggest quarterly loss of the year so far on the S&P 500. The blame game, many things to blame. Pick out a bond market, 2-year, 10-year, 30-year. Let's slice and dice the yield curve. 2-year yield higher by 6 basis points, 5.1%. 10-year, 462.89. Last quarter on the 10-year, up 73 basis points, up more than 40 basis points in September alone. Just a monster move in a 10-year yield. On a 30-year, getting comfortable with the idea that the 30-year is trading in the 470s. 474, yields up by 4 basis points. So this curious moment, we avoid a shutdown. Equities pop for about 5 minutes, they fade. Yields are up, and that sticks. Sticks again right now, up by 5 on a 10-year. The story in the FX market, euro dollar, 11 weeks of euro weakness and dollar strength. Can we make it? Week 12, euro 105.35, negative 0.3%. Yen weakness out there as well. Dollar yen 149.73, getting closer and closer to 150, up by 0.2%. Two opposing forces right now. JGBs have been selling off. Yields have been higher. We conclude the BOJ is comfortable with a high yield. How much higher and how quickly that can move higher, we don't know. BOJ stepped in once. It's going to step in twice. Bramo, just to cap the speed, maybe not put a line in the sand as to what level they like, but ultimately, as they do that, yen weakness coming around the corner all over again. And this is why we're closer to 150 this morning.
They're going to be buying 5 to 10-year JGBs starting on Wednesday. What this does, if they reduce yields, then they lessen demand for the currency, and that's what you see. So they're this push-pull kind of place, and which gives first? And you raise the question, which do they care about most? What's the rate of change that they care about most at a time where it's unclear what their ultimate destination is?
Clear that they're uncomfortable with the pace of that move in the Japanese government bond market. We'll keep one eye on that. Under surveillance this morning, the US government avoiding a shutdown after approving a stopgap measure that will keep it funded until November 17th. However, the last-minute deal does not include $6 billion in support for Ukraine. President Biden and leadership in the US Senate urging Speaker McCarthy to resume aid. McCarthy is looking to tie support, though, for Ukraine to immigration and border security. Tom, this, I think, just sets the parameters for a fight for the next month in Washington.
Well, the fight for the next month in Washington, but what's fascinating about this, and I don't mean to be like Bramwell Gloom about it, but I feel like I'm watching 1938, where FDR's doing Lend-Lease in Europe, trying to get funding of America for something we don't want to look at in Europe. Why is this any different? We don't want to do Ukraine, so there's this growing emotion of saying, why are we funding Ukraine? And, you know, I thought some of the comments by the leaders this weekend were really quite clear. We're doing this because they're fighting our war. There's some serious comments this weekend.
There's also a concern about the signal to European allies, especially because there's some splintering going on. There was that Slovakian leader that was just elected on the basis of not supporting Ukraine. So at what point does this give ammunition to some of that voice over in Europe at a time where we are heading into a really tough winter?
You'd have to get the, I think you can draw the conclusion, Lisa, that the support for the Ukraine war effort on the Republican side was already fading. But the issues at the southern border have become so much more prominent. But even now you're seeing Democrats, think Kathy Hochul, New York governor.
I said this weekend.
Coming out and just starting to lean towards, Tom, the conservative point of view. And Bramo, that's a change. That's a change. And tying the two issues, conflating them the way Speaker McCarthy is going to over the next month, it's going to make things really tense and really difficult going into a big election year.
Here's my question. Is Kevin McCarthy going to cater to the centrists or to the right part of his party that he already has kind of moved away from?
He decided that this weekend with a vengeance.
Did he? But is he going to follow through on that? Because if that's the case, is there some sort of consensus in the center on both of those issues?
I think so. I think on board. I think you're dead on. I mentioned it twice this weekend. There's this growing bipartisan shock over migration that was not there 1 year ago, 4 years ago, 6 years ago.
It's there front and center now, that's for sure, particularly over the weekend. A couple more stories to get through. U.S. auto workers, the strike marking its third week. The latest sticking point. being benefits for workers at electric vehicle battery plants. The UAW President Sean Fain expanded the strike against Ford and General Motors while sparing Stellantis on Friday. The union is still calling for a 30% pay hike, down from the initial 40% at the start of negotiations. And your last story here, one we've been following, Apple saying software updates are coming to the iPhone 15 after reports of overheating. The company admits the devices can get hot during the first few days of setting up or restoring the phones due to increased background activity. Apple denies that any heat issues, Lisa, are related to the new A17 processor, or for that matter, you can't blame the titanium case either.
We heard this from Dan Ives, right? He was like, it's a software glitch.
It's like verbatim what Dan
I mean, seriously,
it's last week.
It's almost like he has this,
plugged
like the tentacles in there, because they're like, oh, we know he's going to go out there and say what we need him to say. Look, I don't know. I mean, if they solve it, why didn't they solve it ahead of time, especially if they knew this was going to be a problem, number one. And number two, this just raises a question about, you know, is this just another manufactured glitch that they can be like, look, we overcame it, and look, we outperformed.
Great. Buy an iPhone, Tom. They're going to overcome this issue. Seems to be the message from Apple. It's not the processor. It's not the titanium case.
What else do you do? Like, they literally blamed, like, Uber and Instagram.
What did Mark Gurman talk about over the weekend?
He wrote a couple things.
He was talking about maybe them developing their own search engine.
Yeah, yeah, this was a bombshell from Mark Gurman, and I'll be honest, I haven't read it completely or talked to Mark, but, you know, there it is. Apple's going to try to compete with Google on search. That's what Gurman does.
Amazing.
Joining us now, Sonia Meskin, head of U.S. Macro at BNY Mellon, with a really interesting short note. She comes with experience from the New York Federal Reserve System and also her work at London School of Economics in Pennsylvania. I love your note on the ambiguity of higher for longer. Discuss the what ifs here of this Q3, Q4 debate over higher for longer.
Sure. Well, the thing to keep in mind here, and I think the market is actually proving that right now, of course, there's the news of the BOJ. But structurally, we believe that the natural rate, or the rate that balances savings and investment in the U.S. economy, has risen compared to the previous cycle. And what that means is that, A, the Fed is going to have to keep rates higher for longer, but it also means that they're possibly not as restrictive as we would have believed them to be in the previous cycle if they'd raised rates this far.
Will the Fed be overcome by events? To me, that's a key thing. You're an acclaimed Fed watcher with your service at New York Fed. Is this a Fed that just has to wait for the data, wait for the dialogue, the narrative, and then act?
Well, it's very difficult to estimate the natural rate in real time, just like it is difficult to estimate the term premium in real time. They're both actually unobservable in real time, which I think is a big reason why the Fed is saying we're just going to wait for the data and see how that shakes out. It'll help with our observations.
Does the data scream right now that we're sufficiently restrictive from your standpoint?
Well, you know, it's hard to say. I think that, in fact, the strength of the consumer, the strength of the housing market, and even the resilience of manufacturing, given the run-up in rates that we've had, tells us that the economy is quite a bit stronger fundamentally than it was in the previous cycle.
How are you gauging that in real time? Are you following companies, a select group of corporations? Are you following economic data? What are you looking at to judge that?
You've got to do both. You really have to look at it from top down and bottom up and compare the two.
Right now, when you look at what the Fed is doing and the fact that we're going to have a meeting today with Patrick Harker and Fed Chair Jay Powell with a group of small business owners who are feeling the pain more substantially, do you think that the Fed has their finger on the pulse, is biased to the right place of possibly not being restrictive enough versus concern about being overly restrictive?
Well, I do think that lower tiers of the consumer are feeling this more than folks that have, you know, high net worth built up. Similarly, companies that are in a somewhat weaker position in terms of, you know, debt issuance are probably feeling it more than those that are well positioned in terms of their cash balances. So yes, we are in a somewhat bifurcated economy at this point, but I think on net, we're still in a much stronger place than we would have expected to be last year.
How closely are you watching the dynamic that John and Tom were talking about earlier, that the interest payments are going up so significantly for the United States, that the deficit is expanding, and there's increasing concern about the ability to pay this back? This leads to either fiscal withdrawal or it leads to something else, which is higher yields and bond vigilantes. How are you gaming this scenario out?
Well, I think that's a very, very tough one. I think that's actually a bigger concern at this point than even potentially near-term consumer or corporate weakness, right? Because if rates rise on a sort of sustainable basis, then it will be eventually more difficult for the U.S. government to refinance itself or finance itself, right? It'll be more expensive to the taxpayer. And at the same time, corporates would have to refinance into a higher rate environment as well. So we will get squeezed potentially from the public and private sides.
But are you suggesting that fiscal policy and fiscal economics will intrude on the monetary policy debate?
Technically, they shouldn't. The Fed should be independent. It takes the U.S. fiscal side as a given. But, it's a tough situation for them. In the past cycle, at least inflation was well contained. This time around, if inflation reaccelerates, say because we have structural tightness in the U.S. labor market, it'll be a very tough situation for them.
Hear this from Andrew Hollenhorst over at Citi. House prices, energy, the tightness of the labor market. Where does that risk for reaccelerating inflation come from for you out of those things?
I think this NFP report coming out will be very interesting to watch, not just the headline gains, but also what's happening with the participation rate. Because, for example, we've had a lot of the gains in the participation rate from foreign-born workers that might peter out, and we'll be back to more of a structural tightness in the labor market.
This raises a major question for a lot of people. Of the inflation decline that we have seen, the disinflation that we've witnessed so far through this year, how much of that has been a result of the Fed's tightening? And how much of it has just been the supply side responding to what we've seen at the price level?
We would say the supply side has been a big part of the story. Certainly there's been some weakness overall in the economy from the Fed tightening, but again, as we discussed, much less than we would have expected last year.
It's hard to point to a significant amount of demand destruction off the back of the Fed's tightening.
Yes.
So how on earth do they know if they're sufficiently restrictive? What on earth is this conversation about?
Well, there's long and variable lags as always, and those are variable. I think, the Fed is leaning into variable and long.
Or maybe short.
That's straight out the cheat sheet of the FOMC, isn't it?
Yep, pretty much.
Bramo, isn't that a confusing point for you
Sonia
too?
memorized it.
I'm struggling with understanding the bond market entirely right now, because how much is this really being driven by those deficits, by the fiscal backdrop? How much do we understand the resilience in the economy? We don't. I mean, honestly, how many times have economists gotten it wrong this year? It's every week is another thing that people seem to miss, myself included.
I agree. You're certainly not alone. Sonia, thank you. It's good to see you. Sonia Miskin there of BNY Mellon. If you are just joining us, welcome to the program. The S&P 500 shaping up as follows this Monday morning. We're negative just 0.01%. Yields are a little bit higher by 5 or 6 basis points, 462.68. We'll catch up with Michael Pugliese, the senior economist at Wells Fargo, at 8:30 Eastern. We'll talk to him, Tom, in about 45 minutes.
It'll be interesting to see with the data coming out today and the adjustments. I mentioned those 4 key dates to get out to November 1, deep into fourth quarter. Can I just say September just sort of happened? Like I don't know if I was there to participate. It was like there was August,
you were present in the
then
seat. The
there
mic
was
hot.
like
we were live.
It rained for
we all experienced.
It rained for 14 days, and then
the weather was brutal Friday into Saturday.
Yeah, and then finally it's October 1, and it's like okay.
Going swimming in Brooklyn on Friday. Did you see that? The pictures out of Brooklyn?
Really, some of our staff was
brutal.
Deep in that. David Gura, with us for years, was directly involved.
I had to try to take one home, and
did you?
I ended up
How did that work out?
It's like an hour and a half.
Like the waterfall coming down?
Oh, yeah, big time. And just basically delayed. Yeah. Don't you find that people tend to be kind of down, too? So it kind of matches the market's move.
Oh, yeah.
When it's
absolutely.
Like skipping around in the rain?
Yeah.
Well, I mean, when it's sunny out, people have this sort of pop in their step. You could feel it in the city yesterday. But otherwise, people are just kind of down.
Let's lift their spirits, Bramo. Tell us what you think about this economy. Make it better. No,
really?
It's not happening, is it?
I mean, it's shown resilience. The fact that you're seeing auto sales pick up.
Dig deep. Nice. Congressman French Hill, Republican from Arkansas, is going to be joining us in about 5 minutes' time, weighing in on the shutdown discussion over the weekend, just about avoiding one. The next deadline, November 17th. Can we avoid a mess then as well? A spat within the party between Congressman Matt Gaetz and Speaker McCarthy. We'll hear much more on that a little bit later on. Balance of Power, 5 p.m. Eastern Time. Congressman Gaetz with Anne-Marie and Joe Matthew from New York. This is Bloomberg.
Steve Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg. On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Are we going to be staring down another shutdown?
Well, it all comes to the Senate. The Senate hasn't done one thing.
But in the House, are we going to be facing another shutdown November 17th?
No, because the House is doing their work. We've already done more than 70% of it. So compare this to the Senate. The Senate hasn't passed one bill. The Senate didn't pass anything about the shutdown.
House Speaker Kevin McCarthy speaking on CBS, the next line of the sand, November 17th. Live from New York City. Welcome to the program. Slightly negative on the S&P 500 to kick off a new trading week, a new month, a new quarter. Welcome to Q4. Equity futures down about 1/10%. Yields are higher by 5 basis points. 10-year, 462.48. The euro against the dollar. Weaker euro again. It's week 12. 105.34 on the euro against the dollar. And crude with a lift, still in the 90s. Tom, 91.24. WTI up 0.5%.
It's a pretty rich data. I mean, it's not like the panic, the sweat of, say, Monday, Tuesday last week, and I can't remember before that. But looking at equities, bonds, currencies, commodities, you got to find a signal here maybe for Q4. And I sound like a broken record, but to me, it's Swiss franc has been resilient and weaker, and that's changed in the last 24 hours.
The only thing that's changed is the date. The story's the same. Yields are up, dollar stronger, equities are struggling. And the dollar strength is happening, Tom, simultaneously at the same time as seeing a rally in crude. It's been difficult, and now it's really difficult for the Europeans. We can go back to that story a little bit later this week.
The oil debate's going to be fascinating. I mean, I don't know really. I mean, Youssef's in Abu Dhabi with Daniel Yergin here in the last 3 hours for Bloomberg, and Yergin just doesn't buy it. He says demand's not going to be there. Sounds like Ed Morse. That's an
Youssef
outlier
brought up
call
the
right
Ed Morse piece over at Citi to get back to the 70s by next year.
Yeah.
Demand's going to soften. You get that supply side response.
Let us dive in right now to what you and I witnessed this weekend. He witnessed it as well. The congressman from Arkansas, French Hill, he's been such a good friend of the show and trying to give us perspective on the history we're witnessing. French Hill, I really take issue with people that say this has never happened before. It's an outrage. Baloney, my reading of history back to Alien Sedition Act is this is frequent. Like Joe Cannon, 1910 is an absolute parallel here. From those analogs of the past, Alien Sedition, Joe Cannon, 1910, what is the outcome for the Speaker of the House you support?
Well, Tom, it's great to be with you. Always good to be on the program. Look, I think Kevin McCarthy should Congressman Matt Gaetz bring a motion to vacate the chair to the House floor. There'll be a motion made to table that motion. And I think Kevin McCarthy survives. Look, Kevin McCarthy has over 200 solid supporters in the Republican Party. You witnessed that in January when it took 15 rounds for him to be elected Speaker of the House. And on your historic point, that hadn't happened that many times since 1923, exactly 100 years before, and I think it was 9 rounds then. So these items have historic precedent, as you point out. Kevin McCarthy has the support of his conference. He's doing a good job as Speaker of the House, bringing to the House floor important measures. He negotiated single-handedly, virtually, a good debt ceiling deal that lowers spending 2024 over 2023 and has some other important economic reforms. And so that's why I think his colleagues will sustain him as Speaker of the House.
You're entrenched in Arkansas. Fine. There are Republicans up north who are not entrenched. And their outrage this weekend seemed to be tangible. Are those Republicans in the north at risk because of the foolishness of the weekend?
It's such an important point. We have our majority, Tom, our very narrow majority, where we can only lose 4 or 5 votes on the House floor. Because we have won districts in which President Biden won. So in New York and in California particularly, we have House Republicans that won successfully with outstanding campaigns in 2022, but they might be in a Biden district +3 or a Biden district +13. And so they are really hurt in their districts if it looks like we're not governing and not honoring our commitments on spending and regulatory policy. In other words, they're conservatives, and they're advocating at home for solid conservative Republican values, but they want to deliver it in a way that makes sense, and this kind of back and forth does, I think, put them at risk.
Congressman, does it help them if you combine the Ukraine aid effort with the aid effort for the southern border?
Jonathan, I think you'll find that we will move a Ukraine bill in the coming days, and that we're building a consensus around what that should look like, including oversight of the administration's strategy in Ukraine to win and win promptly. But look, overwhelmingly, and you've seen it in vote after vote, there's a majority of members of Congress that support Ukraine funding. They want to make sure that other countries are doing their part. They want to make sure that that money is transparent, and they want to make sure that the Biden administration is encouraging a strategy in Ukraine that can win and win promptly. There's definitely fatigue after the stalemate of this summer along the front lines of Ukraine.
Why is it important to combine that with the border security issue, which essentially is what Speaker McCarthy communicated over the weekend?
Well, this is an important political point domestically, Jonathan. People are stunned by the incompetence of the Biden administration to secure the border. Over 6 million people have crossed the border. Over 151 people on the terror watch list have crossed the border. Hundreds of pounds of fentanyl that can kill the Americans many times over. And 200,000 people a month are coming across the border, setting a record up 25% from last year. So I believe, and I hear this from my constituents, the governor of New York has even called out the National Guard on this issue. So every state's a border state. We think the most pressing domestic problem, besides getting spending under control from the pandemic, is the border and border security. And that's why I think Speaker McCarthy set that out. Let's find a compromise and do something about border security, honor a commitment. We've passed that bill across the House floor only with Republican votes. We call it H.R. 2. And we'd like to see if we can get Democrats in support in the Senate for border security. There is a strong majority to support Ukraine under the terms that I just outlined. So let's do both. Let's have two wins by working together.
Whether it's the border, whether it's Ukraine, whether it's the budget, whether it's getting Kevin McCarthy to remain a speaker, Congressman, are you finding sort of a greater ally in centrist Democrats right now than the far right of the Republican Party?
Well, inside the Republican Party, we have some goals. We want to secure the border. We want spending below the pre-pandemic levels to the best that we can, considering the wins that we locked in the debt ceiling deal between President Biden and Speaker McCarthy. Those are shared priorities inside the Republican conference. We're still educating, in my view, our members on what is the best course forward for Ukraine. I admit there's a party split there, and I'm disappointed about it. I'm a strong supporter of kicking Putin out of Russia. It's an outrage that he's there. And there are many reasons why Putin was green-lighted to invade Ukraine that date back to the Obama administration.
Yeah.
where we are is where we are, and we're doing that work, I think, to find consensus on how to move forward on Ukraine.
Congressman, I guess that what I'm trying to say is if Speaker McCarthy remains Speaker, there are going to be some Democrats that basically give a pass to it. Is there increasingly a centrist coalition that's going to have a greater influence going forward?
I think it could be. Lisa, you saw that in the run-up on trying to find a solution in this most recent conflict on the end-of-year spending, where you had centrist Democrats work with Republicans to try to find a way forward for a continuing resolution. So you may see that continue, and if so, that may be in the best interest of the American people if centrist Democrats come to the Republican side and work with us on things to cut spending, secure the border, and properly fund assistance to Ukraine.
Congressman, I've known you long enough to know that these issues frustrate you. Shutdown debates, debt ceiling issues. Do you think your colleagues in Washington understand that they're losing the privilege to act recklessly based on what's developing in the Treasury market?
Jonathan, you are so right. I have made that point repeatedly over the last month. Looking at that 10-year this morning at over 4.6 gets my attention. Moody's comments get my attention. And one thing that we had, and you'll all appreciate this, in the Republican continuing resolution that failed on Saturday, all the Democrats voted against it, and 31 Republicans voted against it. Very disappointing. Very disappointing. It would have secured the border, cut spending by 8% for 4 weeks. Was a debt commission, Jonathan, and that's exactly what we need is a bipartisan Alan Greenspan type approach dating back to 1983, where we solved Social Security solvency at the time and produced a 40-year positive outcome for that very, very important program for our seniors. That's the kind of approach we need to take on finding a bipartisan solution to long-term fiscal concern on that 2/3 of spending that the U.S. Congress does not debate.
We got to talk more about it. We can do it. Maybe in Alabama, Razorbacks Bama, October 14th. Congressman, thank you. Congressman French Hill of Arkansas. Live from New York City, this is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Earnings are going to continue to grow next year.
We have seen a lot of sectors, a lot of companies already move through an earnings recession.
We are seeing some signs of consumer confidence just starting to return a little bit.
That consumer and that labor market is something that we are very focused on.
If we're not slowing enough, if we're not in a scenario that looks like a recession, well, then you just get some inflation coming right back.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. On Monday, equities, no. Commodities, no. Currencies, no. John, bonds. Price down, yield up.
Again, yields up this morning. 2-year, 10-year, 30-year, 10-year at the moment, back in the 460s, 30-year in the 470s. Congressman French Hill 10 minutes ago talking about, Tom, the recklessness in Washington and the contribution we've seen from that to this in the bond market right now.
I don't disagree with that. And Lisa mentioned the interest payments on the national debt, but what's really front and center here, folks, this is very deceptive. You see us run banners of intraday highs in a yield and that. Forget about the spikes up, John. If you just look at the central price of a given bar chart, right now we are at new high levels for yield on a daily basis, not an intraday basis.
It's been amazing to see over the last couple of weeks. Last quarter, 70 basis point move. 70 basis points and change on a 10-year yield. Andrew Hollenhorst City publishing just moments ago. Looking ahead to payrolls Friday, here's his number. 240,000 new jobs and a drop in the unemployment rate should confirm that growth remains solid, but with upside risk to inflation from tight labor markets. TK, which is why he's looking for another move from the Fed next month.
And that's one view, and there's other views as well that cut the other way. The narratives that are out there, we've got to sort out. And as I said earlier, I've got October 6th, October 12th, October 13th, out to a November 1 meeting. I wonder what Jay Powell's going as for Halloween.
What do you think?
Ambiguity.
Mortgage rates?
No, he'll go for ambiguity, I think, because that's
long and variable lags.
Long and variable lags.
No, Yellen did that a couple of years ago. Anyways, November 1 is the Fed meeting. That's going to be an important date. But these key data points, yeah, I guess jobs matter, but I'm all inflation report. I'm sorry.
My main data point is the bond yield. At what point does that shift up at such a high pace that something breaks? And this is the question, why are stocks not recognizing how quickly bond yields have gone up, or have they? Is this something that everyone can adapt and adjust to at a time where we're leading to the highest yields that we've seen going back to 2007? This, to me, underscores the lack of a rally today after we did get some resolution in Washington, D.C.
Over the weekend, into Q4, Lisa, what's the spread market look like? I mean, there's all this doom and gloom in commercial real estate and that. What's the actual spread story?
I will say that it is not a spread story. That what we heard there from Sonia Meskin was the exact opposite. This is a government bond story. This is a story about full faith and credit in the AAA rated company, or the AAA rated sovereign debt that is the benchmark for all other borrowing costs. If you have an unmooring of that, something breaks.
You could be unmooring, you could be unanchored, or you could just completely miss the call. I mean, we haven't even talked about this.
I know exactly where this is going.
John, I'm an idiot, and I don't understand offsides in soccer, and I could tell that Liverpool goal was a goal.
Yes. That's impressive.
I mean, this is they can't even get the rules right in English football. How do we expect the Fed to get the rules right?
You should have heard the drama in the Bramo household. The screaming. Liverpool fans over there.
Yeah.
Was Bob Michael, was he medicated?
I'm sure Bob Michael was tremendously upset about that. The goal was onside. The video assistant referee knew it was onside, thought the referee had called it onside, realised too late. I say too late, in their minds they thought it was too late to go back and basically call it a goal, which is kind of bizarre.
Right.
Now there's all these talk about, you know, maybe replaying the game, which I find utterly ridiculous. These things happen all the time.
I didn't know that.
I'm sure the fan base would like it to happen, but I don't think that happens.
Let's do an onside data check right now. I'm going to go to the 10-year real yield. It is a fact. It is 2.27%. John, I can't say enough about yields up right on resistance.
Treasury's down and down hard over the last month, the last quarter, the last week. 4 weeks of yields climbing on a 10-year. On a nominal yield, 463, yields up by 6 basis points. That's the 10-year maturity. On a 30-year, up by 4 or 5 basis points to about 475 currently. So yields up, dollar stronger, euro weaker. 105.30 on that currency pair, negative 0.4%. And crude, the rally continues, even with that dollar strength, 91.20. WTI, Tom, up here by 0.4%. Equities just giving way just a touch. To Lisa's point, that pop on equities after the resolution, if we can call it that, in Washington over the weekend, doesn't stick. It fades pretty quickly going into the opening bell.
Yeah, we'll have to see into the opening bell. I'd like to get through to the end of October. David Leibowitz briefs this morning, global market strategist, JP Morgan Asset Management. I love within your research note where we've come up to these levels and there's a huge now what? If I'm in a bond analysis of higher yields, how does it redound over to my analysis of the equity market?
So I think what's so interesting is you talked about the dispersion of views, you talked about all of the things that are bothering the bond market today. With that type of uncertainty brewing, I mean, you'd arguably be looking for bond yields to move in the other direction, not continue to move higher. And I think that, to me, is what's a little bit unsettling about what's happening here. And equities continue to shrug it off for whatever reason. You know, but profit estimates for 2024 have been rising, which has been difficult for me to wrap my head around. And, you know, I would go back, Lisa, to what you were saying is, if rates continue to rise the way that they've been rising, eventually there's going to be a financial accident. Eventually something is going to break, and that's what is going to get the Fed moving in the other direction. But it seems like the equity market still has this idea that the Fed's going to ease for easing's sake in 2024, and I just can't get there.
Things did break. Earlier this year, the financials did. Do you think they're well insulated now from what's developing in the Treasury market over the last 3 months?
I think the larger institutions are well insulated. I think that there are probably still some problems in the small to medium banking space. You know, what was so interesting about what happened back in March was not necessarily the event in and of itself. That's obviously been well covered, but the response from the Fed. And what did they do? Well, they injected liquidity into the system. Rates came back down. And look, we've baked those cupcakes before. We know what that does to the economy when you lower rates and inject liquidity. So that should have been the point in time when we all looked at each other and said, there's probably more legs to this expansion in this market rally than perhaps we thought coming into the year. But, you know, my view here is if rates, again, it's about the speed of the move in rates. And to your point about north of 70 bips last quarter, that's quite a move.
Which raises a question. You said something will break, but we've seen markets stop being markets. I could argue that the housing market is broken. Yep. It is not moving. People are buying new houses because nobody wants to move and no one wants to borrow at 8% rates. You're seeing that in corporate credit, certain cuspy areas, and I know that's a jargonese phrase, but you see the more risky securities are not trading. There is a lack of liquidity underpinning this move. How closely are you tracking that?
So I would add to the laundry list that you just laid out, if you look at amend and extend activity in the bank loan market, that's running at a pace that we haven't seen since the financial crisis. Auto delinquencies are up, credit card delinquencies are up. We're seeing a lot of signs that things are moving in not necessarily the most positive direction, but then you juxtapose it with the personal income report that we got on Friday, which showed that consumers are still out there spending away. And with 70% of the economy being the consumer, there's probably a little bit more room for this to run, but eventually you have to imagine the labor market begins to cool off.
Is the new playbook the same as the old playbook? If eventually we're just going to basically boil this frog until something breaks, the Fed's going to step in with stimulus, you're going to end up with lower yields, which turbocharges the next leg of the rally. I mean, why not just get long stocks and expect the Fed to bail you out?
So I think the reason that we would be hesitant to embrace too much risk in portfolios today is that if that boiling the frog scenario does play out, there is downside risk to growth and there's downside risk to corporate corporate profits. And so we would view equities as needing to pull back in the event of that materializing. But I don't think you're completely wrong. You know, if the Fed responds by lowering rates, I'm not sure that they're going to do a whole lot of QE. I don't think that there's appetite for that. But, you know, investors at some point here will get exactly what they're looking for, which is easier policy.
James Dimon will be with our Emily Chang this morning. His mandate, which he will show as a more longer-term perspective. All of this is great short-termism. At J.P. Morgan, with a 3-year perspective, what do you do with equities?
So what do you do with equities? I think you avoid the names that have driven the rally so far this year from a pricing perspective.
Do you sell them or do you avoid them?
I don't think you sell them. I just don't think
I walk into your shop with Microsoft shares. I've been lucky. They've been a moonshot. You're telling me to sell them?
No, I'm telling you that that's not where the incremental dollar should go today. I think that you need to focus on valuation in this type of environment because the securities that are looking overextended from a valuation perspective arguably stand to fall the furthest. I also think that there continues to be a tremendous opportunity in fixed income. And you know, you look at 2-year, 5-year, 10-year paper, not that I would do that with my entire portfolio, but taking advantage and locking in some of those yields today, even if there maybe is still some upside on the 10-year, doesn't feel like the worst playbook from my view. I think you need to think about managing risk in this environment, not just going for the most return.
Well, let's talk about sectors right now within equities. Avoid, maybe take. What do you like at the moment?
So it's an interesting barbell that we're embracing today. On the one hand, we like the more defensive dividend payers, so the consumer staples names, the utilities names. I know that they've been under pressure due to the rate story, but I do think that they will pay off, you know, over the course of a 9 to 12 month horizon. We also like energy. And you look at what's happening with oil prices today, energy is obviously highly cyclical, but you look at the shift that we've seen in the underlying approach that these companies are taking to managing their businesses. They're focused on capital efficiency. They're focused on returning cash to shareholders. These are completely different from the private equity-backed businesses that we saw in the early 2010s, where it was about how much volume can you pull out of the ground. They're actually now focused on profits, and profits are going to be key if multiples come under pressure.
Last month, it was energy versus discretionary. Energy up, discretionary really suffered, had a terrible month in September. Great year so far still, up for 2023. That confidence you have for energy, do you match that with some bearishness around discretionary?
I do. I think that the reality is that the consumer is beginning to come under pressure. And there are different estimates of all of this. If you look at the Fed's numbers, the excess saving ran out over the course of the summer. You look at the savings rate, it continues to run well below its long run average. Credit card debt is up, although consumer leverage, if you normalize it based on income, is only back to where it was pre-COVID. It's my impression here is that the consumer is very much in the process of bending rather than breaking. But in that type of environment, discretionary isn't a place where I want to hang my hat.
Terrible for some of the airlines over the last month or so, Lisa. Absolutely brutal for some of those names.
Higher oil prices, people pushing back on prices, and you see that the most in the airlines that cater to families and to people going on vacations and less to international business geared kind of travel.
JetBlue.
Yeah, that's basically what I'm talking about.
And what I think is so interesting about that is if you listen to the management teams, they only raise their prices if they think the demand is there.
Right.
And what we're seeing in the airlines where they've had that pricing power is that demand is beginning to fade. I think it dovetails nicely with the overall view on the consumer.
I was top tier JetBlue, David, for a long time, and they didn't carry over my privileges. Yeah. That's who I'd fly domestic with for business travel.
Really?
In the US, yes.
Where'd you go? Miami?
West Coast.
Really?
West Coast, JetBlue. The mint offering was decent, and then we came out of the pandemic, and Mr. Hayes would not push over my privileges for 12 months. So, you know, we did that live on air.
Yeah.
He said I should fly more, so I didn't. David, thank you. David Liverts of JP Morgan. Welcome to the program. If you're just tuning in, the S&P 500 negative here by 0.15%. My favorite line on the airlines this over the weekend. United Airlines would save $80 million a year if the average passenger weight fell by 10 pounds. Jim Bianco, I think, reading minds out there at the moment. You know those slaughterhouse-type scales? Jim Bianco of Bianco Research said, imagine those scales at the airport that you and your bags have to step on. If over a certain weight your credit card is charged, that would do wonders for public relations. It's another Ozempic trait. That's what this is.
That's not.
But there's somebody in front of me
is.
checking 6 suitcases into these ginormous suitcases. And I guess they pay extra for it. But at some point, the beast can't get off the ground.
Well, I mean, you pay extra for the suitcases, but that would not really look good when you have people basically going on the scale, and they have like a meat scale, and then they have like, you know, a number that starts going up.
We should get the analysts from Jefferies on this. This is real Southside research, okay? And we should have this conversation about how they envision it working. Is this just a benefit of Ozempic that the average passenger weight will fall? by £10.
The side effects are real, and I'm just curious about, this is what
Look,
we're
people
hearing.
throwing up on the plane.
People are eating their breakfast, John, but the side effects to Ozempic need to be explored before we can start trading around the entire economy on them.
All my radar is up.
Maybe people are.
I'm not, full disclosure, I'm not doing Ozempic or whatever it's called.
Okay, thanks for that disclosure.
Snoozing. Why are you laughing, David? Stop it.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
Senator, you just voted for a short-term deal that doesn't include a cent for Ukraine nor for the U.S. border.
Right.
How did you swallow that?
We had to keep the government open. We got 45 days to fix both problems. I listened to Kevin closely. There will come out of the Senate soon a bill that will have 3 legs to it. I believe there's bipartisan support in the Senate to do both, and it will go to the House hopefully in the next 30 days.
That's the next big effort. The deadline, November 17th. Senator Lindsey Graham of South Carolina speaking on CBS just yesterday. If you are just joining us, welcome to the program. Counting you down to the opening bell for Q4, 1 hour and about 13 minutes away. Equity futures negative here by 0.2% on the S&P after falling last week, last month, and last quarter. Hello Q4 with yields higher again by 6 basis points. Tom, your 10-year, 463.51.
Tanya, I like Kit Chooks where he says currency trumped out by bonds. I think that's a really interesting concept, to get into October where bonds frankly really matter more.
Oh, yields up, dollar stronger. Yeah. Story of the last 3 months.
Yeah. I'm looking at the real yield, 2.28%, really has my attention, a 5 basis point move. We're going to pause here for 45 seconds. Lisa, John, and I, there was a point where we literally didn't see each other for months and months with COVID. And we determined with our producers, with our team, that we had to cover COVID. John, we did it with Imperial College London, Johns Hopkins University, and their science. And you see it today in the Nobel Prize. This is to the University of Pennsylvania. And John, this goes back to Watson and Crick in the 60s, to David Baltimore and recombinant DNA, to this miracle of the 3 of us walking into an office and we get a shot. And you say, well, it'll be a big deal, and I make jokes about it. These are the people that made the Pfizer shot. And this is a triumph for all the voices we talked to.
That news out this morning, Tom. Congratulations to Catalin Carrico and Drew Weissman.
Just a huge, huge deal. I can't say enough about it, and to our team for our coverage through COVID. And frankly, you know, we may have more coverage. I'm seeing more masks right now.
The Nobel Prize in Physiology or Medicine for 2023.
Yeah, and well, it's mRNA. This is a huge deal going back 50 years and really well-deserved for the whole scientific community. Knowing that as Jeanette Lowe, Director of Policy Research at Strategas, because if we had shut down, we probably would have shut down our science complex across our federal government as well. Jeanette Lowe, we did not shut down. Medicine will move forward. Science will move forward. Ukraine won't move forward. As Senator Graham talked about, do you just see an easy path to legislation where the United States of America provides ammunition to Ukraine?
Yeah, this does not look like an easy path at all. Obviously, it was a little bit of a surprise that there was no government shutdown. We did not expect Speaker McCarthy to actually cross his caucus and work with the Democrats to pass a bill to keep the government open. So we don't have a shutdown yet. We might have another shutdown risk come November 17th. And we still have a tough road to hoe here until then. So we still have to figure out what we're going to do on Ukraine funding. We still have to pass the budget. And then Republicans really do want to do something about the southern border. And so it's still going to be a bit of a tough leg here where they really still have to figure things out. And Speaker McCarthy is going to see some challenges to his speakership probably as soon as this week. And he could see multiple ones of those over the next couple of months, which is going to make it really difficult to be governing in Washington.
What I find interesting, Jeanette, is that everyone we're talking to today speaks as though House Speaker Kevin McCarthy will still be in that position in the months to come, albeit with some consternation with certain parts of his committee, his team. How much are you looking at the possibility that he does not remain Speaker for the foreseeable future?
So we think that he can't pass this first vote. So we think, the initial vote that's going to come up, we think that there will be an effort to save his speakership. It might be that Democrats vote for him. It could be more likely that Democrats actually just don't show up for the vote or vote present, so that it gives him a smaller margin to actually reach that threshold and remain Speaker. However, we don't necessarily anticipate that that's the end of the story. We think you could see a continued votes brought up. It could be over a couple of weeks, and eventually that might start to wear down the process and figure out, that he ultimately may not be able to survive the speakership long term. The problem is, of course, that they do need an alternative, and the alternative still has the exact same Republican caucus that they need to manage. And so they're still going to have these small number of hardcore members who are going to be pushing for holding out on spending bills and other priorities that they have. And that makes it a lot more difficult for the moderate wing of the party to be able to get things done as well. So it's still going to be, regardless of who is Speaker, it's still going to be a very difficult path moving forward.
I'm trying to be an optimist here that we're not just doing deja vu all over again on November 17th. And how much are we looking at anything that actually got done other than just kicking the can down the road?
So obviously they needed more time, right? So we needed a continuing resolution regardless, because they were never going to get appropriations done. We do have 6 weeks now, so that's a little bit of a good piece. There's efforts not to have it move into December. We could always see another CR that moves into December. But at some point they need to kind of take this big vote, and we do need to pass a budget. And there's a lot of moderate members who really do want to get that done. So what we're going to be looking for is what happens over the next couple of weeks. We think that it's going to be kind of a volatile process, but there is still the push probably that's going to happen where we're going to have an omnibus bill, where we're going to ultimately get a budget done. You're going to put a bunch of other provisions in there. We might see something on immigration, see something on Ukraine funding. If it gets pushed even further into the end of the year, you might see even more things added in there. But they do have to probably get something done, especially before they move into the 2024 year, when it's an election year and you have election politics playing a part.
Jeanette, you mentioned migration earlier. The raging debate is a GOP issue. I don't buy it for a minute. I see Democrats nationwide adapting and adjusting. What will be the Democratic Party path on migration in the next 90 days?
So right now, the Democrats are saying that they are, kind of pushing against some of these changes to who can come through the border, having people being able to stay in the United States while they're asylum, cases are being heard rather than having to be held in Mexico or held in another country. But you are seeing immigration have an impact across the country, and you have a lot of Democratic cities and states that are also having to deal with a large influx. So at some point, there is an opportunity, I think, for a bipartisan compromise. You're just probably not going to hear it as much from the members of the progressive wing in the Democratic Party in Congress. But I do think that you're hearing more conversations about there has to be some changes that are going to be made. And there is an effort, you had Senator Sinema from Arizona trying to put forward some moves to come up with a bipartisan solution here. And eventually, if you want kind of Ukraine funding and something on the border, that does create a nice bipartisan mix. And there might be something that we can get done ultimately.
Jeanette, do you expect that Democrats in certain states are going to start to sound like conservatives on certain issues? Congressman French Hill was with us about 30 minutes ago, and he made a point, I'm paraphrasing here, that the border issue was every state's issue now, that every state essentially was on the southern border. Do you think that's going to change the politics domestically going into next year's election?
I do. I mean, I think that you are starting to see some tensions within the party on that. You have Democratic policymakers who are in charge of cities or of states that are having to deal with the immigration flux and the sheer numbers of how many people that they're trying to deal with and then process and get onto, a better place. And that's creating tension with the administration, that they're not potentially maybe doing enough, they're not providing enough aid to the states. And so you are starting to see the tension there. The rhetoric may not change as much, but I do think that there is going to be more of a thought to be a little bit more, maybe say practical, and saying, we have these large numbers of people who are coming to the country. We actually aren't even able to manage them. So we do need to make some changes. And it's going to probably play into electoral politics next year. So Democrats also have to think about what are people seeing on the ground and how does that issue then impact them? They can't just ignore the fact that there are cities that are struggling with these new influxes of people, and that's going to be important to take into consideration.
Change of tone has been amazing. Jeanette Lowe of Strategas, a bad company. Jeanette, thank you. Change of tone from Governor Kathy Hochul here in New York. Virtue signaling a few years ago Tom was free. It has a price now, that's for sure.
I totally agree, and I don't think it's just New York City. I think it's really across the nation. It's absolutely original.
Live from New York City. The opening bell about an hour away. Equity futures negative 0.2%.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg Surveillance 8:30 economic data, not on a Monday, October 1 or 2 or whatever it is.
It's October 2nd.
John Farrow, he's like deep into the 9 a.m. show right now. No economic data, but I guess it's a big deal later on this morning.
We've got ISM manufacturing, and 15 minutes before that, we get S&P global U.S. manufacturing PMIs, and this comes at a time where people are looking at new strength in manufacturing as people shift
strength
back.
and yield, too.
Well, and that's part of what's underpinning it, because you're sort of not seeing that altogether downturn that people were expecting.
Yeah, and rounded up, 150. We're not there yet, 149.74. Lots of tea leaves here in an October Monday to get acquainted with. One of them just came in off the transom. David Rosenberg, Toronto, Canada, reminding us that 2.2% is the 3-month annualized inflation statistic for America. Many would disagree with that. And then there's a basic idea as we launch into Q4. Are we fighting the last war? Michael McKee knows this is something we're very good at. Let's talk fighting the last war, October 2023 at Vintage. Is Rosenberg right that we just, we're looking back and looking at high inflation everywhere and just saying worry narrative, except disinflation's?
I don't think the Fed's doing that. They're looking at the same numbers as David is, and they're doing the annualizations as David is. It's really a question of, does this continue? They know that they have made a lot of progress on inflation, and if you're looking at the PCE numbers right now and extrapolating out no change in the monthly gain, you're looking at 3.3 to 3.5% for the PCE core at the end of the year, and the Fed was forecasting 3.7. So things may be better than anticipated. But I think the markets tend to want to fight the last war, or at least prepare for the damages that could come if the last war reasserted itself.
Is there any indication that you get from which Fed speakers speak and where they speak? And we were talking about this, that Fed Chair Jay Powell alongside Philadelphia Fed President Patrick Harker are going to be speaking with small business owners and consumers who might be feeling higher rates more than others. Does that tell you anything?
I don't think so. I think, there's a choice to talk to the small business owners, and maybe they made this because they want to deliver a kind of a hopeful message to people. But most Fed speeches or things like this are planned well in advance. So I don't think there's a specific message that they want to deliver other than things are getting better and we're on the job.
Well, there's also a feeling right now, baked into market expectations, that we are seeing, given the fact that we're going to get data on Friday, the reason for the Fed to go again in November, to raise rates, and that seems to be part of what's underpinning the bond move. Do you think that the data that we have seen, other than David Rosenberg's point of view, has justified, under the Fed's circumstances, an additional rate hike?
I don't think it has so far. This is why this is such an interesting week, starting with the ISM manufacturing today. Everybody will look to the prices paid and employment sub-indexes to see what it's telling us about what's going on. And then you have a number of other employment indicators this week. You have durable goods. We'll see how businesses' investments are going. And then, of course, the jobs report on Friday. And all that will feed into the jobs report on Friday. So we may see some changes in what the forecast forecasts are. But right now, it doesn't look like there's any reason necessarily for them to go. But I did think it was interesting if you take a look at the chart of the November 1st Fed futures.
Where is it right now?
Well, they went on Friday. They were at about 15% because we thought the government would shut down. As of today, it's over 30%. It was it's one of those hockey sticks up because people all of a sudden, well, now we could have a problem.
Just possibly fighting the last war. Michael McKee, thank you so much. Lisa, quickly, the yields, 5.10%, 6 basis points in the 2 years, 6 basis points to a 464 in the 10-year. I'm watching the 30-year, 4.75. Are we getting near an 8% 30-year mortgage?
We're looking at some of the highest levels that we've seen for mortgage rates even further back, right? More than 2 decades. At what point, again, I keep going back to this, at what point do risk assets fully price this in, or have they? Because right now, that is one of the biggest debates on Wall Street.
It is October. Too many people are out there going, where are my kids going to go to school, and will the faculty be competent? Every once in a while, you throw your kid to a school like University of Virginia, and they work for a rock star. Joining us now is Michael Puglisi, senior economist at Wells Fargo. And as we advance to November in the 60th anniversary of an event that changed my life, the assassination of John F. Kennedy, this is a kid at UVA who helped Larry Sabato do the definitive book on JFK and 50 years forward. Michael Puglisi, before we get to the economics, what was it like helping the acclaimed professor write this 50-year treatise on JFK?
Yeah, well, thanks for having me, Tom. And it was a great experience working with Professor Sabato on that project. I mean, not just the book, but the documentary. I wasn't around for the Kennedy presidency, and so I got to learn a ton about what that was like and the impact it had on politics, not just at the time, but as it resonated, 60 plus years on the echo his presidency had on the United States.
We've got an echo of economics now, the impact of politics right now on Wells Fargo economics. Do you ignore the shutdown and all the rest of this foolishness, or do you have to fold it into your Excel spreadsheet?
Well, you don't have a choice but to fold it in. I think the encouraging thing for the Fed as they go to that November meeting we were just discussing is it looks like they're going to get their economic data, right? It seemed like going into the weekend there was a good chance we'd wake up today, no JOLTS report, no jobs report, maybe no CPI report next week. And now it looks like the Fed is going to have that, and they've staved off the economic hit from a shutdown for at least another 6 or 7 weeks or so.
That said, there is this profound dysfunction that starts to creep up and into bond yields. And we were talking about that with Sonia Meskin earlier this morning. What is the concern that you have, that we are concerned about weakness on some level, that this is not a rip-roaring economy, and that any concern, whether it's about a government shutdown or weakness elsewhere, is not being felt in longer-term bond yields that keep going up?
Yeah, it's been surprising. I mean, given all the headwinds the economy is facing, right? The Fed that remains so hawkish, the student loan payments restarting, fears of a shutdown, the UAW strikes. I mean, the list just seems to go on, and that's just in the United States, let alone a recession in Europe and elsewhere. But I do think it makes a little bit of sense, just given what's happened over the past couple months on the fiscal front and the supply front. You've seen deficits that just keep widening. They look like they're going to be 6 to 7% of GDP for the foreseeable future. At the same time, the Fed's quantitative easing, or quantitative tightening rather, is adding bonds to the market on a monthly basis at a pretty steady clip with no end in sight. So I think maybe finally you're starting to see some term premium come back into the market, at least until we see more meaningfully weak economic data.
Well, how much then do you have to factor this into some of your economic projection? Does this slow growth, in other words, on a more sustainable basis, simply because there is going to be a term premium? There is going to be a question about whether the U.S. government can keep paying the interest payments with the same debt load that they're looking at, and it questions fiscal expenditures going forward.
Yeah, I mean, the way I think about it is when you start to get to this position in the cycle, this position of monetary policy stance, the economy it only has so much more forward momentum. I mean, where's the growth going to be in 2024? I think it's going to be very challenging. Monetary policy acts with a lag. Rates more broadly act with a lag. And that's why we've got a recession in our forecast still for the first half of the next year, whether it's higher oil prices, the student loan payments restarting, these much higher yields, the higher mortgage rates we discussed a moment ago. I think all those factors are going to come together to really constrain growth next year.
Where are your stars that you're following? We started the show talking about how there are a lot of stars in a cloudy sky, and we're going to try to find them, and some of these metaphors that aren't working for me at a time when we just don't have the data and everyone seems like they're really uncertain. What are you trying to follow? What's your lodestar?
Yeah, the navigators are always looking to the stars for the right direction, right? I mean, to me, the way I think about it is what's the Fed looking for at a fundamental level? They're looking for slower inflation, a continuation of that, 2.2% 3-month annualized core inflation rate that we've had over the past few months, continuing that into next year. And they're looking at the labor market and saying, so far, we haven't seen any meaningful pain. Job growth has slowed, but it's still at 150,000 jobs a month or so. Unemployment's below 4%, and that's what's going to drive the reaction function. Is one, the inflation data and realizing that continued slowdown, and two, do we realize any economic pain, particularly on the labor market front over the 6 months? That, to me, is what's really going to drive the bus.
Well, final question here, Michael. That's it, and it's the heart of Wells Fargo's research and heritage, back to John Silva. When does the unemployment rate finally jump? I see no evidence.
Yeah, it takes time, right? If you look back to 2008 and that tightening cycle, the last hike occurred in June 2006. You didn't see a recession start until December 2007. That was 18 months later. And of course, we're not forecasting any kind of deep economic downturn like we had back then.
Right.
But I think it serves as a reminder that even after that last hike, which we may not even have had yet, it takes time for that policy tightness to filter through to the real economy and actually generate the slowdown that you're referencing, Tom.
Do you have a Fed prediction for November 1?
I don't think they're going to hike. I think that what you're going to see over the next month is a continuation of the trend in the data we've seen. 150,000 jobs a month is where we're at for Friday. I think something along the lines of another 0.2 or so on core CPI. And as long as we realize that data, I think it'll be enough to hold them off for the next meeting.
Michael, thank you so much. Michael Puglisi of Wells Fargo and at the University of Virginia, I can't say enough about this book. This book got rave reviews about the 50-year reach after the assassination of the president, the Kennedy half-century. Larry Sabato, I'm going to give a co-write there to Michael Puglisi. It's not there because he was a lowly, undergraduate student who cared, but the Kennedy half-century, he had a lot to do with that informed book. John Grisham, among others, gave it a rave review. Isn't that cool, Lisa? Like, you go to school, and I did the research thing and was hugely advantaged. Nothing as big as that. But nobody ever talks about when you get lucky and you have a faculty member who's a rock star, and you're bouncing off them.
Do you have memories of rock star faculty?
My freshman advisor at Colorado was George Gamow's son, Igor Gamow, who's the #1 guy in the world on how snakes tell the temperature with their tongue. True story. I went in his lab once because
never went in again. Just lots of snakes.
It stunk and it had snake smell, and the whole thing was surrounded by snakes, a few of which I really didn't want to get. I went to saw my faculty advisor once,
and after that he bought snakeskin tops. Otherwise, not so much. Not doing that.
That's what you get. But for Michael Puglisi to do that with Larry Sabato is just really, really, really cool. We're going to really dive into bond analysis here. It's important. Let's look at some of the other stuff as well. Dollar elevated. I got a yen 149.76. Really important in their Tuesday evening tonight. Equities, I got red on the screen. 18.33 on the VIX. In the commodities space, Daniel Yergin with Youssef over in Abu Dhabi, really good. 92.70. Oil's, maybe a little bit diminished from where we were. The Standard & Poor's 500 down 0.2%.
Tom, we really do have to pick up on what we're seeing in bonds right now, because particularly the 10-year, and this is coming on the long end, we're seeing really pop up back towards some of the highs that we haven't seen since 2007, 4.639%. Why? Wow. Is this because essentially you're going to get the economic data, you're not going to get the slowdown that some people were predicting from a government shutdown, so suddenly people are gaming out higher rates for longer to an even greater degree? Is that what's going on?
I totally take the ambiguity, the mystery of your why, in that technically these charts are really, really elegant. The fact is, take your yield, 10-year, whatever, 30-year. We're moving out. And this is critical, folks. Why don't you see red headlines across the Bloomberg? We do intraday analysis across all of Bloomberg LP on bonds, but on a daily pricing, as we speak, on many of these yields, we're out to a new high, rounded up, U.S. 10-year yield 2.28%. Moments ago, rounded up 2.29%.
So one viewer wrote into me who is really smart, saying that this is not so much.
We have smart viewers?
We have
Yes.
very smart viewers that are smarter than I. And they were talking about how this is essentially a buyer strike, that there are people interested in these bonds. We heard about that from David Leibovitz. They want to capture these yields. But you don't want to catch a falling knife, and right now there feels like there's something else going on. To me, this is really the question. When do we get that buying activity? What does it take? Does it take something breaking? Does it take some sort of, bigger Japanese move?
If John Farrow was here, he's out at his St. Regis breakfast this morning, very fancy. John Farrow would look at the German 30-year bond enjoying a 3% yield. That is untenable in Germany. Stay with us all through October. This is Bloomberg's Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
The big issue that's happening, people are not talking about in the oil market, is the strength of non-OPEC plus oil. The growth in the United States this year is 1 million barrels a day. Brazil, Canada. Canada is going to grow 500,000 barrels a day next year. And so it's basically is that the non-OPEC plus oil is growing faster than demand. That's the factor that goes unremarked in the discussion about oil prices.
Non-OPEC plus. I can't really get my head around just exactly what we're talking about. Daniel Gergen, as a global vice chair with a long trajectory and incredible academic credentials when it comes to the oil market, we are looking at oil as sort of another one of the shoes in this toxic brew, and I can't even say that with a straight face anymore, that's leading yields to go that much higher. Our focus very much on the yield picture this morning, Tom. We've been talking all morning about the fact that even with the triumph of the government reopening, we are seeing risk off and we are seeing bond yields up.
I'm going to state something's going on here, folks. It's a Monday. We're slipping into October. We had a beautiful Sunday in New York. Finally, nobody's focused. Get focused now because the markets are talking, and they're talking price down, yield up. No question about it.
When you take a look at the specific names, you're not really seeing that much more of any kind of direction. Let's just be really honest. We're in the sort of pre-earnings churn turn as people try to game out what's going to happen with October 13th, JP Morgan coming out. But I did want to look at the consumer discretionary, in particular cruise lines, since we love cruise liners here on Surveillance. And you can see just that leg lower, again, with Carnival and Norwegian in pre-market trading down more than 1% on both of those. Honestly, I'm curious about consumer discretionary at a time where you are seeing some signs of stress. You are seeing borrowing costs going up. In surveys, people do feel bad. They are recognizing the inflationary outlook. Gas prices are going up. So for these cruise lines, you've got expenses going up and you've got a real pushback a little bit more potentially for the prices for passing it along in the consumer prices. So I keep watching the consumer discretionary from that vantage point. And then Deutsche Bank, those shares lower by almost 1% after news came out this morning about the German financial watchdog BaFin, basically saying it has appointed an independent monitor to oversee Deutsche Bank's progress in resolving some of its issues.
Our work on Jane Fraser here, and I mean, there's been a little bit of a rebound in Citibank off of 4.00. The low was, $3.99 on Citigroup, reverse 10 split. We've bounced back up, but I'm sorry, the banks, as I mentioned throughout all the show today, are worth watching.
Well, they're worth watching because on one hand, they should benefit from higher rates. They've been talking about this for a while, but if they're crimped by regulation and if they're crimped by the pace of the move up, really torpedoing market activity, that creates a problem.
Yeah, and we're seeing, I got a 2.29%, up 6 basis points on the 10-year real yield. I'm sorry, there's something going on here is all I got to say about it.
Right now, I definitely want to get a sense of the look forward, especially heading into the October 13th sphere. Gina Martin-Adams joining us now, our equity guru over at Bloomberg Intelligence, overseeing all of the incredible research that you guys put out. Are you surprised that people keep upgrading some of the earnings forecasts?
I am and I'm not. The nature of the earnings growth forecast is not particularly surprising because a lot of it has come from last year's weakest players starting to recover this year. Recall there's this sort of disconnect between the earnings series and the economic data, where last year earnings went into a full recession. Maybe the economy did or did not. The economy apparently held its own. We have not heard that we were in recession, but the earnings were in a very deep recession. This year has been about an emerging recovery from that earnings recession for certain sectors, in particular the biggest 5 stocks, which are now producing net income growth of nearly 30% year over year to substantiate that rotation. We're also seeing consumer discretionary, as you alluded to earlier, consumer discretionary earnings growth powering forward and upgrades continuing in that space. On the other end of the spectrum, though, you've got consumer staples where earnings downgrades continue to pressure that space. Expectations are even lower. So if there is some consumer distress, it's mostly in the day-to-day, lower income earning consumer focused groups. The staples are actually experiencing greater distress than discretionary right now. So there are a lot of moving parts in the earnings stream, some of which have been surprising, some of which have simply just reflected where we've been and the recovery that we've had, which is entirely about inflation. And inflation really pressuring earnings last year has become less of a problem this year.
We all have our narratives. In securities analysis, we have our narratives as well. It's something I talked about in the last hour. Gina Martin-Adams, you're sitting down with 40 of our best and brightest in equities, and you say, look, we're fighting the last war intellectually. How do we get beyond October 1 from the emotion of the last 12 months to clear thinking for the next 12 months?
We become incredibly data and model dependent, right? A lot of what's happened, I think, in the equity markets is sort of behavioral, where our sensitivity to various macro components, our sensitivity to rates, our concern overwhelms the reality of what's happened in the data. And if you become incredibly data-centric, if you become very data-dependent, you get out of your own head, get out of your own narrative, you do find that there are rational movements in the equity markets, but you do have to spend a lot of time digging through the data and digging beneath the top line. The S&P 500 is in this just fascinating state right now, where the top 5 have driven all of the positive price performance. Most people think that that's some sort of irrational exuberance around, the top 5 stocks. But frankly, the top 5 are the earning components of the S&P 500. There's a rational argument for this when these stocks are driving 30% earnings growth while the rest of the index is still in earnings contraction.
So we're fighting the last war, which is all behavioral. I think totally agree with you on that. And if we've got to get back to data, you and I are going to stack. It's Monday, so we're not doing a 5-ratio DuPont. We're only doing a 3-ratio DuPont.
You get to wait
till
Wednesday for that.
And I'm sorry, I'm going over to the right side of the 3-ratio DuPont. Forget about the details, folks. Leverage and operating leverage is a positive catalyst away from behavior.
Oh, I think this is an absolutely huge point right now, because this goes back to what I was talking about earlier, where inflation really depleted the ability of companies to perform over the course of last year. Inflation created a lot of disturbances in 2022, most importantly on the margin lines. So when you talk about that operating leverage, as the companies experienced a slight deceleration in volume sales, they experienced a really big escalation in cost pressure. And many of the companies reacted, right? We had very big jobless claims. We had very big losses in increases in layoffs. We started to see the unemployment rate tick a little bit higher finally this year. But this is really what happened last year. Now you're starting to see these companies really benefit from these behaviors and a decreasing cost of inputs. You're seeing the input costs decelerate even more than revenues are decelerating for many of these companies, and that's resulting in this leverage, which is creating the earnings recovery.
Given that, does it make sense to you that consumer staples are doing so poorly?
Yeah, because consumer staples are underappreciated for their inflation sensitivity. This is one of the most inflation-sensitive sectors in the S&P 500. They obviously, right, you think, okay, what does a grocery store's cost? Well, a lot of that is the cost of goods. It's the cost that it's coming into the store. If the cost of cereal is up precipitously and the consumer is going to shift down to non-branded cereal items, that materially impacts a grocery store. The same for especially the dollar stores, the Dollar Generals, the dollar stores of the world are very sensitive to what happens at the pump. So this reacceleration we've had over the last couple of months in oil prices and gas prices precipitously impacts that segment of the world. Right. So a lot of this makes sense because it's about inflation, and it's about the consumer response to inflation and how that is shifting over time. It's creating a lot more volatility for consumer staples than I think a lot of investors would like to acknowledge, but it is absolutely impacting that.
I've got to get this in. I mean, Farrell's got 8,000 shares of Birkenstock coming, and I know Gina, I can just see, can you see Gina wearing the wool Birkenstock Boston?
What is the problem with Birks? Like, what is the obsession? I don't understand it. They are perfectly good sandals.
I agree.
I got to go back to a Birkenstock question, you know, way back when we were looking at dead reissues. Gina Martin Adams on the re-advent of LIFO-FIFO.
Okay.
Which sector is best benefited by LIFO-FIFO?
Yeah, it's most impactful. Yeah, you're really crushing me.
I'm fully aware. This is incredible.
Inventory is most impactful in the materials and industrial space. Actually, it's not as much in the consumer space, but it is in the retailers. Retailers are certainly impacted, but when you look at services companies, which are a much bigger portion,
Walmart benefited by a new LIFO-FIFO analysis?
They could be benefiting in 2023.
Could be wearing clogs right now.
Now this inventory is crushed.
Okay,
honestly.
that was low.
I'm going to take this seriously.
Yeah, please.
Inventory's really crushed.
It's just to keep plowing through.
Inventory's really crushed the retailers, in particular Walmart and Target last year. Right, last year that was a big story. Remember in the summer months, we had all these write-offs even from Walmart and Target because inventories were incredibly problematic. It is actually helping to some degree to have had those write-offs.
There we go. It's a LIFO-FIFO pop. We got to go because Jamie Dimon's more important than Gina Martin Adams. 10 o'clock today, James Dimon in London with our Emily Chang. An important discussion, the tech advantage at JP Morgan Chase. Tune in tomorrow if you choose. This is Bloomberg Surveillance.
LIFO-FIFO Birkenstocks.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So GPT,
making a machine that's in our own image, in a sense, that's what AGI sounds
more than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know,
Right,
next
absolutely.
fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get Q4 started. Live from New York City this morning. Good morning, good morning. Your equity market just a touch softer here. On the S&P, we're down by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, waving good riddance to the worst quarter of the year. Congress just about avoiding a government shutdown, allowing us to look ahead to the payrolls report. We begin with the big issue. Hello, Q4.
As we look to fourth quarter.
The fourth quarter's got these weird things.
Financial headwinds continue to mount.
Everything from oil prices rising,
student loans restarting,
rates still remaining elevated.
They are going to hurt consumption.
Consumer could come under pressure.
It seems very, very hard to talk about positive economic activity in the fourth quarter.
Last quarter was very difficult.
The third one was quite stormy.
The market is likely on better footing.
You should be starting to see an inflection point in earnings after 3 quarters of negative earnings growth.
We could very well be set up for a good fourth quarter.
We're circling this earnings season as a critical one.
The risk for the fourth quarter is, can the consumer continue to surprise on the upside?
Joining us now to discuss is JP Morgan's Jack Manley, Seema Shah of Principal Asset Management. Seema, first to you, what is there to like about this stock market in the fourth quarter?
Hey, John. Well, look, there are a lot of headwinds. We've already heard that from the people just now. Energy prices, you have, of course, the sell-off in bonds as well. But at the same time, the thing that we have to like about the economy is just it continues to be so resilient. You know, the economic data keeps pouring in. It still shows a solid economy. So I do think that there is weakness ahead, but I'm not convinced that Q4 is going to be the time that you start to realize some of that weakness that we're anticipating.
Let's talk about that recipe for weakness. Jack Manley, you know the names. Energy prices. This is the blame game. Energy, higher rates, student loan payments resuming. Do you see a real test for the consumer building here into year end?
I am concerned a little bit, John, frankly, especially because the fourth quarter is such an important shopping season, right? We know that this is when the consumer really goes all out heading into Thanksgiving, the December holidays. This is when we like to spend, and we are facing down a very significant wall of worry with all those things that you just mentioned and maybe a few others, too. So I do think that there is some risk to the consumer as we move into this critical shopping season. That means that there is a little bit more of a risk to the economy than I would have expected even a couple of months ago.
Discretionary stocks got hammered in the last couple of weeks, seem. I just wonder how much of that test this market has already discounted.
I think it's, the consumer, I think everyone is familiar with that story, and, I don't disagree with anything that Jack has said. I'm just saying it's moved out until Q1 now. The discretionary stocks, they are definitely very vulnerable. They're more vulnerable than a number of other sectors. But I think when we start to think about Q3 earnings season, I think generally speaking it's going to be fairly strong. And that should maybe turn around and maybe give the equity market a little bit of a boost that it's been missing in the last quarter.
Asima, is that the no landing story from earlier this year all over again?
No, I think, so we have to be careful about this no landing. I don't fundamentally believe in the no landing. If you have very strong growth, it ends up in high rates and then you get a hard landing. I think this is more about, apologies, about pushing out the date of that recession. And we know we're bored of talking about recession. Economies keep pushing it out. But we have seen that the consumer has really been helped by fiscal policy. And so it's just, we're thinking it's moving out into 2024 rather than right upon us in Q4.
Plenty of tests further down the road. Let's talk about a test for Tesla right now. Third quarter deliveries, 435,000, a little north of that number. The estimate, 456,722. That stock is a little softer here. We're down by about 3% on Tesla. We'll talk about that name around the opening bell. For the week ahead, tons of data points, including payrolls on Friday. Lots of Fed speak, including Chairman Powell a little bit later. Let's get to Mike McKee for more. Morning, Mike.
Good morning, John. Well, we are not under a government shutdown, so there is going to be a lot of data this week. And as we start quarter four, we're going to start trying to figure out what's going to happen in quarter four and beyond. ISM manufacturing kicks us off today. That'll be important. People will be looking at the prices paid and employment indexes. Jay Powell is making an appearance before small business leaders in York, Pennsylvania. Not sure he's going to say anything in particular, but keep an eye on that. JOLTS, of course, and auto sales on Tuesday. ISM services on Wednesday. Also look to that employment data. The ADP report comes out in durable goods. As you can see throughout the week, we have a lot of Fed speak. Jobless claims on Thursday. Will that be distorted by the UAW strike? And September jobs, we know that's not going to be distorted by the strike at this point, but it is still going to be an issue. So where do we go from here? Well, Seema was talking about the idea of pushing the recession out. Economists surveyed by Bloomberg, and we put out the latest numbers last week, see the economy just barely skirting a recession in the first quarter, going down to 0.1% for growth, and that is not necessarily something we can, say is missing recession. That's going to feel like recession if that is indeed the case. So what does that mean for the Fed? Well, we had a big turnaround today in Fed funds futures for November 1st. We had gone down to about 15% likelihood, and now you can see we've bounced right back up since the government is open. The market is starting to think more about a possible other Fed move. We'll get a much better clue by the end of the week when we have all this data.
You said it a million times, Mike. There was a fear we might not have any data at all this week, and now we're going to get it. Mike McKee, thank you. Andrew Hollenhorst City, looking for one more move, potentially November. Looking for this on Friday in the payrolls report, 240,000 new jobs and a drop in the unemployment rate should confirm that growth remains solid, but with upside risk to inflation from tight labour markets. This bond market down again, yields higher. If you're just joining us, here are the scores right now on a 2-year, 10-year and a 30-year. The 2-year still above 5%. The 10-year yield higher by 7 basis points at 464. The 30-year higher by 6 basis points to 476. And Bank of America published in the last hour, a little bit earlier this morning, saying this: equities can still work in a higher rate environment. The S&P 500 returned 15% year on year from 85 to 2005, with real rates at 3.5%. Jack Manley, how much of a challenge is there from real rates in this bond market to stocks at the moment?
Well, we have to acknowledge, right, that where rates are at the moment is certainly a greater hurdle for equity investing than where they had been just a couple of years ago, right? Stock investors are going to need a little bit more out of the stocks that they're investing in to justify taking that additional risk. But, you know, when I look at the equity market right now, I could absolutely see this market continuing to trudge higher despite that higher rate environment. I think what this points to, though, John, is the need for a quality overlay in portfolios. You know, money's not free anymore, and I think that even when the Fed does pivot and ultimately move rates lower, it won't be taking those rates back down to zero anytime soon. Businesses are going to have to be a whole lot more thoughtful about how they're allocating capital. Investors, in turn, are going to have to be a whole lot more thoughtful about how they're allocating capital. I'm not trying to make a style bet right now. I'm saying quality, and frankly, I think this is just a heck of an opportunity for active management as well. That's how I stay constructive despite the rate environment.
Jack, what is quality? What would you point to at the moment?
The quality right now, to me, is consistent, dependable earnings, right? Of course, there can be some sort of cyclicality in there. That's always going to happen. Booms and busts in the economy will translate into booms and busts in earnings. But that stability, that dependability, able to generate earnings day one, as opposed to something that may be coming our way 5, 10, 15 years down the line and something more speculative, more growthy, that to me is what quality looks like.
Seema, what's your take?
Very similar to what Jack's just said. You know, we're not thinking really about styles. You want to think about pricing power. Inflation is coming down. Even if it were to pick up a little bit, we're not looking at what we saw at the start of this year. So companies are going to be under pressure. So you need to have big names, big balance sheets, things that can deal with this higher rate environment, which seems like it's likely to persist for longer than certainly what we've seen over the last 10 or 15 years.
Do you think this stock market, Seema, can live with 5% interest rates on a 2-year, on a 10-year at 464, and with real rates through 2%?
So look, I think the jury is definitely out on that one. You know, if you're talking about the Jamie Dimon 7%, no, I definitely don't think equities can live with that. I think that something would certainly break. The thing with bonds is it's really the speed of the move up. How disruptive has that been? It has been a very, very significant and sharp rise, and yet equities have digested it. So I almost feel that they have gone over the hurdle. And from here, as long as you're not going to get the Fed moving up significantly further from here, I think as long as growth is there, then equities have got a little bit further to go.
Move in bonds has been phenomenal. Move of more than 70 basis points on the quarter. 4 weeks now. 4 weeks of yields higher on a 10-year, up by about 7 basis points right now at 464. And 4 weeks of equity weakness on the S&P 500. Longest weekly losing streak of the year so far as we kick off Q4. About 20 minutes away from the opening bell. Equity futures here down by about 0.35% on the S&P 500. Jack Manley, Seema Shah are going to stick with us. Let's get you some movers going into the open. Here's Abby.
Well, weighing on futures this morning, John, is certainly what you mentioned earlier with Tesla, with that bit of a delivery miss. The stock right now is down nearly 4%, and this, of course, as their deliveries for the third quarter came in a little bit above 435,000 and well below consensus at 461,000. We'll be digging into that a little bit more on the open. As for NVIDIA, though, we have some strength, and for Coinbase, too, we, of course, have Bitcoin up more than 4%, and in addition, we do have Coinbase winning a Singapore license, so the stock surging there. And then NVIDIA off of its highs, but nonetheless, it was upgraded to a conviction buy from Goldman Sachs. So we do have a little bit of a bounce there for NVIDIA.
Abby, thank you. We'll catch up with you around the cash open in about 20 minutes' time. Coming up, Congress avoiding a shutdown.
Congress passed the spending bill that's going to keep the government open. And it's good news for the American people because the government will not shut down and a needless crisis will have been averted.
Team coverage up next.
The younger generations are more, of course, pay more attention to sustainability, And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
Needless crisis will have been averted, saving millions of Americans needless pain. There's no Ukraine funding in this agreement. Despite that, I did not believe we could let millions of Americans go through the pain of a government shutdown. But let's be clear. I hope my friends on the other side keep their word about support for Ukraine.
The United States avoiding a government shutdown, with the Senate passing a last-minute 45-day funding bill just 3 hours before Saturday's midnight deadline. Ukraine aid, a major partisan sticking point, dropped from the final text. Meanwhile, a power struggle playing out in the House as Congressman Matt Gaetz pushes forward with his threat to remove House Speaker Kevin McCarthy.
I do intend to file a motion to vacate against Speaker McCarthy this week. I think we need to rip off the Band-Aid. I think we need to move on with new leadership that can be trustworthy.
I'll survive. This is personal with Matt. Matt voted against the most conservative ability to protect our border, secure our border. He's more interested in securing TV interviews than doing something.
Now it comes down to a handful of moderate Democrats deciding to support McCarthy or withholding their vote. Let's get to the team coverage. Anne-Marie and Katie Lyons down in Washington, D.C. AMH, first to you. Are we doing this all over again on November 17th?
Well, potentially we might, Jonathan. They came to this last minute, really an 11th hour agreement. Everyone, including us in this program, been talking about it, looked very likely that there would be a government shutdown. But they didn't, and we have until November 17th. It also includes $16 billion with disaster relief, which a lot of people in the likes of New York or Florida or Hawaii are very happy about. Two big things to watch out for. One is that Ukraine aid. That was not included, and President Biden said he hopes McCarthy takes it up quickly. McCarthy, though, yesterday directly linked it to the border. He said the border is my priority. And then the second thing, Jonathan, is, of course, they should be working on those 12 appropriation bills to actually fund the federal government. But a massive headache and distraction is about to hit Capitol Hill this week, and that's when, as Matt Gaetz has vowed, to have a motion to vacate for the speakership.
Kayleigh, can the speaker hold on?
This is the key question, John. Of course, Matt Gaetz has been threatening this for some time. Speaker McCarthy has always had this hanging over his head because in order to get the gavel in the first place, he agreed that any one member could file a motion to vacate. So as Anne-Marie said, Matt Gaetz does plan to do that this week. It's just a question of whether he can actually garner a majority in the House to oust the speaker. It is going to require a number of Republicans to come along with him, assuming that all Democrats would cast a vote to oust McCarthy. And that really is what is not clear at this time. There probably are enough hardline Republicans who would turn on the speaker, but the Democratic issue is one that really is going to be up to the leader, Hakeem Jeffries. Several Democratic members of Congress, when I spoke with them last week, suggested if McCarthy worked with them in a bipartisan manner, which ultimately he did to pass the continuing resolution, then maybe Democrats could act to save him by either not showing up to the vote or voting present. But there are also a number of issues Democrats have with McCarthy right now. He yesterday, when speaking on Face the Nation, attempted to blame them for the almost shutdown. He also, of course, has launched the impeachment inquiry into President Biden. Both of those things Democrats take real issue with, so he may have to make some concessions to them, possibly tying it, for example, to the Ukraine aid that Democrats really want. Either way, it's going to be very difficult, very dramatic, and we should keep in mind here, even if McCarthy is ousted, there's not really a likely successor to him. at this point, and that would leave some degree of chaos in the House of Representatives.
More chaos down in Washington, D.C. Speaker McCarthy, Anne-Marie, making the point that Congressman Gates was more interested in securing interviews. He secured one with you a little bit later on this afternoon. Walk us through what you expect to get from that.
Yeah, that's right. Well, listen, Matt Gaetz definitely wants to try to drum up support for this motion to vacate. The key question is, does he have those votes? As Kayleigh was just pointed to, the hard right flank of his party, will they really want to oust Speaker McCarthy? Because who is the alternative that can get the majority of those votes? And there is a lot of reporting that he's talking to Democrats about seeing if they would sign up to make sure that he's ousted and not potentially leave or vote present. So I think really trying to understand from him where he is on the numbers, that is something that is going to be key for that interview.
AMH, looking forward to the conversation on balance of power a little bit later. Anne-Marie and Katie Lyons, thank you. Congressman Gaetz, 5 p.m. Eastern Time, live from Capitol Hill in Washington, D.C. Jack Manley, Seema Shah back with us. Seema, I spoke to Congressman French Hill a little bit early this morning, Republican congressman out of Arkansas, and I asked him whether his colleagues realized that they were losing the privilege to act recklessly when it came to these kind of issues because of what was developing in the bond market. Seema, how much of what is developing in the Treasury market over the last few months or so would you associate with the budget deficit in the United States?
Oh, a significant part. And I actually look at the equity market response and the bond market response. It makes perfect sense. The equity market typically knee-jerk reaction to various events, but it typically peters out. The bond market is looking at the fundamental underlying impact of the fact that the budget deficit continues to grow and at some point needs to be dealt with. So really this higher for longer in central bank rates, but also higher for longer in bond yields is really about that deficit size. I mean, there are a number of other issues, of course, but the deficit, I think, is the one which is going to keep rates probably higher than certainly what we've been seeing in the last 2 decades.
Jack, we know the recipe for the sell-off. Strong data, yield curve control exit over in Japan, QT, rate hikes, take your pick. Jack, I just wonder how much of this has been about Treasury supply.
Well, I think supply is a good portion of it, right, to fund all that debt that we were just talking about. You know, you can talk about some of the fundamentals that exist out there. You can certainly talk about Fed policy and how that's helping to shape at least the short end of the curve. But there is so much supply out there and likely a whole lot more coming our way if indeed we do keep on spending, which it seems very likely that we will. I have a hard time believing that you're going to see meaningful downward pressure on the curve, particularly towards those longer dated securities.
With that in mind, Seema, to that point that Jack's just made, what are the limits to this sell-off, if that's the dominant driver?
Well, look, some of our models are suggesting that a 4.9% handle should not be surprising. So for us, we are not overweight duration at this point. We're expecting a little bit of a leg up, and only do you see the yields start to come down once you see visible signs of economic slowdown, which, as I said before, we're not expecting until early 2024. So for the time being, this is just going a little bit further up.
So Seema, just sit in the front end and let this play out into year end. Is that the ultimate view for you?
I think you need to have exposure at the short end. You know, we have to think about, look, if you're going into a downturn, you do need some kind of downside protection. So we're sitting neutral, we're not underweight, but sitting neutral means that you can have some exposure without being too exposed to a potential further up move.
Jack Manley, are you on the same page when it comes to that?
You know, there's obviously nothing wrong with being on the short end. There's a whole lot of yield over there with not a whole lot of risk. But I wouldn't say necessarily that I'm going to be underweight on duration. I just like where coupons are at the moment. You do have a really healthy buffer. And I think that if you are taking, you know, a 12, 18, 24-month lookout period as opposed to being a little bit more tactical, you can stomach further upside move in something like the 10-year, given where coupons are right now, understanding that eventually when rates do move lower, likely at some point next year, that duration trade's going to kick in and your total return story is going to be quite attractive. So I am balancing between a short duration and intermediate.
It seems 3 months might feel like a long time. Just to put some concluding points on the points that you've made over the last 20 minutes or so, that the resilience we see in the economic data could well be with us through year end into early 2024. Now, with that in mind, how challenged do you think, say, valuations might be on tech stocks on the S&P 500, given the developments that you expect between now and year end?
Okay, so I mean, tech stocks are clearly under pressure. They've been under pressure for a couple of months. It's not even just after this this sell-off that we've just seen. They look frothy at the beginning of summer. They continue to look frothy. We continue to own mega cap tech stocks. And the reason is it's not about the valuations today. It's really about what we're expecting to do with AI. So we're not going to add exposure at this point, but I'm not selling because I do believe in the longer term productivity potential a lot of these companies.
So you're thinking more about NVIDIA, Microsoft than you are perhaps, say, Apple?
Yeah, I think you want to have greater exposure to AI. I mean, that has to be the long-term theme. The problem with Apple and some of those is the consumer discretionary aspect. You know, you're going into, I agree with Jack, there's going to be a bit of a consumer downturn probably beginning in 2024. So some of those Apple company is going to be under some pressure from a weakening consumer. So you do need to play it fairly wisely. But broadly speaking, that mega cap stock, because of the balance sheet, the pricing power, continues to be one of our favoured areas.
Seema, what do clients say to you when you say this is the quarter for consumer weakness? I've said a few times over the last month or so that it's almost like the economists have cried recession in 2023. Have we got to that point where people have just stopped believing it?
So we are expecting consumer weakness to be shown visibly in Q1, it's not quite in Q4. But actually that narrative is, I think, ringing some bells with a number of clients. They're also looking at the student loans, they're looking at the mortgage payments. You know, we look at the Taylor Swift, the Beyonce impact, and they know that's fairly much behind us. So actually there is, I think, growing support for this idea that this is going to be a consumer-led downturn. They don't believe it's going to be particularly deep or sharp, but they do believe that a weakness is coming for the economy next year.
Hey, Seema, thank you for the update alongside Jack Manley. Seema Shah there and Jack Manley. To the both of you, thank you. Coming up the morning calls and later, Citi Stuart Kaiser joins us around the opening bell on whether investors need to buckle up for the road ahead. As we kick off Q4, equity futures slightly negative. We're down 0.2% on the S&P 500. Your opening bell, the cash open, 7 minutes away.
Connection lost.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Inching towards the opening bell, about 5 minutes away to kick off Q4. Equities just down a touch here on the S&P by about 0.2%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley upgrading US Steel to overweight with a street high price target, naming it as a top pick and highlighting transformational investments. Your second call from Susquehanna upgrading FedEx to positive from neutral, viewing long-term upside opportunity as greater than the near-term cyclical risk. That stock is positive by, let's call it 1%. And finally, D.A. Davidson upgrading Clorox to buy from neutral, seeing sentiment improving after a crippling cyber attack in the month of August. That stock bouncing by about 1.9%. Coming up on this program, seatbelt sign on or off. Citi Stuart Kaiser joins us around the opening bell. That opening bell is about 4 minutes away. Equity futures right now negative by 0.2%. The cash open just around the corner.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Two seconds away from the opening bow this morning. Good morning to you all. Equity futures pulling back just a touch. We're down by 0.2%. Ugly week, ugly month, ugly quarter. Welcome to Q4. Let's see if any of this changes. On the NASDAQ, we're positive by just 0.01%. There's your opening bow, kicking off the fourth quarter. Switch on the board and get to the bond market. Yields higher by 7 basis points. Your 10-year, 463.92, coming very, very close in the last week to 470. Let's see if we get closer again this week, going into payrolls on Friday and the ISM a little bit later. Yields up, stocks down, dollar stronger. 105.23 on the euro. We're negative by 0.4% after 11 consecutive weeks of euro weakness and dollar strength. Can we make it week 12? $91 on crude. WTI right now positive by about 0.3%. About 25 seconds into the session, your equity market just a touch softer. We're down by 0.1% on the S&P and a similar move on the NASDAQ as well. One stock to watch at the open, Tesla. The EV maker's Q3 deliveries missing estimates. The stock a little bit softer by 2%. Abby has the story. Morning, Abby.
Good morning, John. And yes, we are looking at a delivery miss for Tesla for the third quarter. The deliveries came in just a little bit above 435,000. The expectation had been for deliveries to come in at 100,000. And this puts into question whether or not Elon Musk's whisper number of about 2 million deliveries on the year, are we going to fall short of that? Now, paired with this news is the Model Y in China, because some of this weakness for Tesla is China. About 22% of the revenues come from China. The Model Y, they are introducing a revamped Model Y in China, and the difference apparently is a faster acceleration, new wheel design, and added ambient lighting. They kept the pricing unchanged, so they're clearly trying to stoke some demand there, at least in terms of volume. Also interesting, John, the stock, of course, up 100% on the year, but if we take a look at the fourth quarter earnings, well, it's expected for a decline, so it's going to be interesting to see how the company talks about that and how investors deal with that if it does, in fact, continue on the year.
A small decline this morning. Abby, thank you. We're down by about 1.7%. Want to stick with EVs. A view on the south side from Evercore, upgrading Rivian to outperform from inline. The analyst saying this: who is the next Tesla? Rivian has a brand that has stuck the US landing, and most importantly, within segments everyone already wants: SUV, truck, and van. Not only has Rivian executed on the production ramp, program, but the company has also far exceeded our expectations on ramping gross margins. That stock this morning down by, let's call it 0.7%. I want to turn to tech. Microsoft CEO set to take the stand today at Google's antitrust trial. The Justice Department hoping his testimony will help prove Alphabet's search division is maintaining a monopoly. Isabel Lee on this one. Hey, Isabel.
Hey, John. So this all began when the DOJ accused Alphabet's search division of unlawfully maintaining a monopoly by paying around $10 billion to search engines and mobile devices to make Google basically the default. And to help prove its case, they want to use Nadella. They want to use Microsoft, a $2.3 trillion company, to prove their case. So last week, an executive already testified that it failed to secure a deal to put Bing search app in Apple's products. And Apple signed a deal with Google. So basically, this is really all just to prove that Google is now the monopoly. Microsoft now is kind of up. Actually, it's trading flat, but year-to-date, it's up around 30% year-to-date.
What a turnaround in the last couple of decades, given that it was Microsoft that used to take all the mud for the same kind of story. Isabel, thank you. The latest there, Microsoft just slightly positive by 0.2%. Turning to industrials, Norfolk Southern disclosing that its recent system outage was related to a vendor product defect, not a cyber attack. Bank of America downgrading the stock to neutral, saying this: we believe this is an increasing risk to future earnings, citing increasing concern about data integrity. Katie has this one. Hey, Katie.
Hey, John. Yeah, it's been a tough couple of days for Norfolk Southern. Late on Friday, of course, the rail company forced to halt operations at the hand of another outage, which impacting its dispatching system, train movements, and terminal operating system. Now, as you mentioned, the outage was ultimately resolved at 1:30 a.m. Eastern on Saturday, but it came just a couple of days after an outage on August 28th. And the bad news, of course, continuing for the rail company today with that Bank of America downgrade from buy to neutral. They also knocked the price target down to $215 from $266. They wrote that the multiple external impacts to the operations is of, quote, increasing concern, and that combined with its data integrity and the suspension in customer moves, Norfolk could see potential share loss to its peers. I'm sure we're going to hear a lot more about that when Norfolk reports its earnings on October 25th. You take a look at the shares today. They're down over 3%. All told, year to date, down almost 23%, John.
And not a great year so far. Katie, thank you. Thanks for the update. Katie Greifeld there. About 5 minutes into the session, equities pulling back by just 0.06% on the S&P. On the Nasdaq, we're positive by, let's call it 0.2%. Let's turn to the consumer. The big focus for Q4. Fears about confidence of US shoppers, denting hopes of a soft landing. The co-CIO of Truist Advisory Services saying this: the triple whammy of higher interest rates, energy prices, and the restart of student loan repayments makes the economy harder to land. Simone Foxman has this one. Hey, Simone.
Hey, John, and to that point on consumer loan payments, we saw at least half a dozen corporate executives at major retailers talking about student loans on earnings calls in the past, say, 6 weeks or so, but none of them able to put an exact figure on how much that could be an impact. Now, we've seen clear signs that the lower income consumer is hurting. We certainly heard that from CarMax, talking about consumers trading down to a different level of car last week. But the big question is whether this bifurcation, this high-end consumer, is also feeling that weakness. Now, last week we did hear some signals that there could be. Costco is talking about discounts on big-ticket discretionary items not generating the sort of demand it had expected. However, shares still trading near their highest since 2022. But some other names certainly under pressure, seeing a pretty difficult quarter. Darden talking about softness among households with incomes above $125,000. They're ordering cheaper alcohol. That turns out to be the case. They're down negative 13%, down 13% since mid-July. JetBlue down 50% since early July after near-term leisure bookings in September were lower than expected, also feeling the impact of those consumer costs. Still, the likes of Carnival saying no decline in onboard spending, still seeing robust demand. And we're certainly seeing consumer discretionary stocks still outperform staples this year. Unclear if that picture reverses as we head into Q4.
Well, last month, discretionary got absolutely hammered. Simone, thank you. Picking up on the airlines, JetBlue down and down hard since the summer. All of them have been. have had to downgrade the outlook off the back of higher energy prices. Energy today still trading in the 90s. So here's the question from Stuart Kaiser over at Citi. Seatbelt sign on or off? 4 reasons for caution: bond volatility, wages, spending headwinds, and a prolonged government shutdown. Contrast that with reasons for optimism, including orderly price action, muted stress metrics, positioning and macro data, plus the one wild card of an upcoming earnings season. Stuart, I'm pleased to say, joins us right now. So Stuart, put it all together. Is seatbelt sign on or off?
Hey, Jonathan, good morning. I might not be getting up to go to the bathroom just this week, but, we do think things are going to, hopefully improve over the next couple of weeks. It'll actually be nice to get economic data this week, to be completely honest with you. If we didn't have ISM and payrolls and then CPI next week, it would have been really hard to drive, kind of without that visibility.
Well, Stuart, one point you've made is this rally has been built on upside surprises. At least this year it has. Stuart, that data, walk us through it. We had Seema Shah of Principal on the programme in the last 30 minutes or so. Stuart, she made the point that she expects the weakness to arrive, but ultimately it will only arrive in early 2024. And we're about to see more resilience in the economic data between now and then. Is that something you anticipate as well?
Yeah, look, that is the big question. I would say, look, if we get data over the course of the next 3 months, excuse me, like we've had over the last 3 months, which is, a strong labor market, CPI maybe not as low as you would like it, but still sort of low volatility on a downward trend, then I think, yeah, that's going to be a net positive for equity markets, and we're going to continue to be able to move higher from here. Obviously, bond volatility has been the bogeyman recently, but I would generally agree. Our economists don't have a recession really in the forecast until early next year, so you wouldn't really expect that economic data to be slowing meaningfully, at least in the next couple of months.
I know Andrew Holdenhorst on the economics desk over at Citi. Stuart, you know him well. I know he's looking for that one extra hike in November, looking for a decent payrolls to report this Friday as well. I think he was looking for something like 240,000. Stuart, with that in mind, can you walk us through what you think the current relationship is between rates and certain sectors in the equity market? Because what we've witnessed this year is tech's done pretty well, even with another down year for treasuries, and banks have struggled, even with rates pushing higher. Stuart, what is that relationship between sectors and rates?
Yeah, look, it's a great question. I mean, to your point, typically speaking, tech would not have dealt with these higher yields the way that they have. But, I think there was a few things going on in the background there. One is just that positioning and sentiment and valuation were so washed out in tech to begin the year that even the move higher in yields sort of didn't offset that. Plus you had, as you mentioned, very, very positive economic growth surprise going on in the background, really difficult regulatory environment for the banks, and, a deal calendar that's been probably not what people had hoped for. So, I think the rates relationship has kind of been overwhelmed by those kind of more fundamental and positioning drivers on a year-to-date basis. Going forward here, our view is, tech is the area that is the most exposed to this rates volatility. And you've seen that, right? I mean, the last month and 3 months have not been great for tech performance at all, and given that that's the narrow leadership of the market, it kind of creates a risk to the market overall.
Do you have a reason to believe then, Stuart, that traditional relationship between stocks and bonds can reassert itself, the more intuitive one, that a 60-40 starts to work again?
I mean, traditional, I think, is a little bit subjective. If you look at the relationship between bonds and equities, from the late 90s until COVID, higher nominal yields were positive for PE, right? And that was because you had inflation expectations so well anchored that when yields were rising, it was really a growth impulse that was driving them. I think ultimately, over the medium term, you would expect that relationship to reassert itself because, the Fed is so consumed with keeping market-based inflation expectations anchored. So I think if you're in an environment where inflation expectations are anchored, then that equities can work in a rising yield environment as long as that move in yields is kind of well contained and driven by the right things. The last, call it 4 to 6 weeks, the move higher in yields has not been coming from a good place, right? and I think that's really what's been hurting tech so much.
Stuart, when you say that it's not been coming from a good place, can you identify more specifically what you mean by that?
Yeah, I think at the beginning of the year, yields were moving higher because growth was stronger than expected. Recession risk was being pushed out, and some of those rate cuts were being taken out of the system. So yields were moving higher really because growth was surprising to the upside. I think over the summer, you started to get more concerns with sticky inflation. BOJ kind of raising the top end of their range. Obviously, a lot of Treasury supply on the calendar into next year. And those were viewed as really not positive drivers of yield higher, actually kind of riskier drivers of move higher, of yields higher, and that's why equities have not responded to it as positively as they had from, let's say, January through June.
So tell me how you'd respond to this then, Stuart. This from Bank of America in the last couple of hours. Savita Subramaniam, good friend of this program. really interesting listen to whenever she comes on a program. She says this: equities can still work in a high rate environment. The S&P 500 returned 15% year over year. I think we're struggling to connect with Stuart Kaiser. He says he's lost audio. Guys, have you got him? Stu, you there? We've lost Stuart. I don't think we're going to be able to reconnect either. Stuart Kaiser there of Citi. Unfortunately, that line is gone. I'm going to share with you that view from Bank of America, regardless, from Savita Subramaniam, saying this: equities can still work in a higher rate environment. The S&P 500 returned 15% a year from 85 to 2005, even when real rates were 3.5%. But to put a bow on what Stuart was saying, what matters here is not whether real rates are higher, but why they're higher. And the reason they're higher over the last 2 months or so, in Stuart's words, not for good reasons, not for upside surprises on the economic data. Let's leave that there. About 12 minutes into the session, equities on the S&P 500 look a little something like this on the S&P. We are negative and then positive by just 0.02%. On the Nasdaq, up by about 0.5%. Coming up on this program, tensions continue on the UAW picket line.
The UAW demands now are for far more than wage increases. They include things that represent actually bankruptcy risk for the automakers.
Team coverage up next.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So GPT,
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models, like really talented graduates that occasionally went a bit weird, it's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacroix Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Were they ready for 2 weeks, 3 weeks? Were they ready for Sean Fain? The answer to that is no. They were not ready for the kind of disciplined, focused strategy that the UAW president has brought forward. That's not to say the demands are reasonable, but clearly the leader of this is not the big three, it's the president of the UAW.
Tension simmering between the UAW and Detroit's big three as strikes expand. This time, sparing Stellantis, but putting Ford back under fire over the future of EVs. The CEO accusing the union of bringing negotiations to a halt.
What's really frustrating is that I believe we could have reached a compromise on pay and benefits, but so far the UAW is holding the deal hostage over battery plants. Keep in mind, these battery plants don't exist yet.
UAW President Sean Fain pushing back right in this. I don't know why Jim Farley is lying about the state of negotiations. We gave Ford a comprehensive proposal and still haven't heard back. Let's get to your team coverage. Mike McKee back alongside us with Anne-Marie in Washington, D.C. AMH, what's the latest?
Well, the latest, Jonathan, is you see that tension between Ford and the UAW, and part of that, what Jim Farley is saying, it has to do with the future of the EV transition, and will those union workers be part of it? A lot of these battery plants, Jonathan, are joint ventures with Asian companies. This is the underlying problem you see with how the Biden administration is really trying to walk a fine line when it comes to these strikes. It's not just that Biden went to the picket line, and of course he voiced his support for labor unions. He wants to be the pro-labor union president in history, but he also is behind that federal funding that's being doled out for electric vehicle transition. And he has courted these executives throughout the past 2 years to make sure they were on board with this EV transition. And that is the bedrock of a lot of tension you are seeing between UAW and the big three.
That's the needle the president has to thread. Mike McKee, I think I've been wondering, others have as well, when we start to see this show up in some of the economic data, are you expecting that in any way, shape or form?
We will see it, and maybe we'll start to see it this month in perhaps consumer spending. It'll hit Michigan first. It will not show up in the jobs report this Friday because the jobs report strike numbers are already out. And we know there were 17,700 people who were on strike, according to the BLS, in the month of September. That does not include auto workers. And oddly enough, it does include the striking screenwriters. So the true number is lower than that now because that has been settled. We might start to see it next month, however. The deal is with the BLS, you have to be off work and not paid for any of the pay period that includes the 12th of the month. And this strike started on the 15th. The 12th was earlier that same week. So there was no reason for them to be off the payrolls. They did get paid for part of that time, so it doesn't show up in the government data. Looking ahead, though, there are reasons to think that there could be problems ahead in the data. Furloughed workers at struck plants can get jobless benefits. If you're on strike, you can't, but if you are furloughed because others are on strike, you can. The strike would have to last till October 14th to affect this next month's payrolls. Labor Department estimates there are 4 workers supporting every auto job. So Bloomberg Economics estimates that if all 150,000 in the UAW go on strike, that would mean 700,000 jobs would be at least temporarily suspended in the United States. But that's still a long way down the road. We're only at 25,000 strikers at the moment.
Mike, we'll hear from tens of Fed speakers today through the week. Today alone, Powell, Harker, Williams, Mester. When we hear from those Fed speakers, Mike, when you speak to them about the state of the labour market, do they see this as a one-off, something unique, or do they take a broader signal away from this current tension?
Well, at the moment, they are thinking and hoping it's going to be unique, that it is going to be a one-time bump, and then it will not trigger a wage price spiral. But, of course, we don't know what the situation is with the companies that have to respond to this, especially the United Auto Workers, and then there's healthcare workers in Pennsylvania who are talking about going out on strike. What do the companies do once these are settled and the raises are big? Do they raise prices again? Does that set off a whole new round?
Difficult questions at the moment, Mike, that we can't answer. Mike, AMH, to the two of you, thank you. A bit of data out this morning. Look out for Mike McKee with Alex Steele and Guy Johnson in about 9 minutes' time. We'll get the ISM manufacturing number, and then it's on to payrolls Friday with the ADP and jobless claims in between. All of that coming up. If you want a sneak peek of payrolls, the payrolls estimate at the moment, and I can bring it to you, the payrolls estimate at the moment is 168,000. The previous number, 187. That number can move, of course. I mentioned that Citi's Andrew Hollenhorst was looking for something like 240K. He's also looking for unemployment to fall back. The estimate at the moment is unemployment does fall back from 3.8% to 3.7. That's a story for later this week. Let's get you some sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Well, the sector action this morning is really, really interesting. The S&P 500 overall, as you know, down slightly, but we have huge moves beneath the surface. To the upside, we have communication services up 1%, helped out by lots of the big mega cap tech companies such as Alphabet, Meta, Netflix. We also have technology up almost 1%, real estate slightly higher. And then to the downside, there are actually 4 sectors down about 1% or more, including utilities, energy, and materials, actually 3, I should say. So again, wide variance. It's going to be interesting to see how this day plays out. And of course, on the year, communication services today higher. It was one of 2 sectors higher in that difficult third quarter. It's the best sector on the year, John, along with the other big cap tech names, or sectors, I should say. Right now, communication services up more than 40% on the year.
Abby, thank you. State of play right now. That's the sector price action. Broader market pulling back about 0.2% on the S&P. On the Nasdaq, slightly firmer, up by 0.3. Even with this move in the bond market, 2-year up by about 6 or 7 basis points, back through 5.1%. 10-year up about 6 or 7 basis points, back through 460 at about 464. Further out along the curve, go to the 30-year, 474 right now, up about 4 basis points on the session, and your dollar a whole lot stronger. Coming up, the week ahead, your trading diary, up next.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Coming into Q4, coming off the back of the worst quarter of the year, the worst month of the year, and the longest weekly losing streak of the year as well on the S&P 500. 4 weeks of this. Can we avoid week 5? On the S&P, we start Q4 in this trading week by pulling back just 0.1% on the S&P, and the sell-off in the Treasury market resumes. Yields up across the curve by something like 4 to 6 basis points, up by about 6 at the front end on a 2-year to about 5.1%, on a 10-year up about 6 basis points to 463.50. That's the price action. Let's get to the trading diary. We shape up as follows for the week ahead. Your week ahead looks like this. Chairman Powell speaks at 11 a.m. alongside Philadelphia Fed President Patrick Harker, head of Williams and Mester later on today. Tuesday, job openings, the JOLTS report. Wednesday, ADP private payrolls and US PMI data. Thursday, another round of jobless claims. And on Friday, it's the big one, drum roll. It's the data we thought maybe we won't get if we had a government shutdown. We've just about avoided that government shutdown for now. It's the data we will get this Friday. It's the payrolls report just around the corner. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. As always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
And good morning. I'm John Tucker along with Bailey Lipschultz, and this is Bloomberg Markets. Both Paul Sweeney and Matt Miller, they are off today, so you're going to have to suffer through the two of us today. Not to worry, just a moment. Our own Emily Chang, she's going to sit down with J.P. Morgan CEO Jamie Dimon. You'll certainly want to listen to that for this exclusive interview. And right now, let's find out what's driving markets. Donald Trump at the courthouse downtown for his civil trial. Waiting to hear from that. And Charlie Pellet will have a look at the markets right now. Charlie?
Looking at the Dow Jones Industrial Average, down 74, decline of 0.2%. S&P little changed on the day, and NASDAQ up 72 right now, a gain of 0.5%. We are awaiting remarks from J.P. Morgan Chase's Jamie Dimon. J.P. Morgan Chase shares, they are flat on the day. 10-year right now, 4.63%, with a 2-year, 5.09%. That is a Bloomberg Business Flash.
All right, Charlie, thanks a lot. And Bailey Lipschultz with us. And let's head to Jamie Dimon and Emily Chang, Bloomberg TV.
Well, I mentioned a big interview that is coming up. We should probably go to that now. We welcome our TV and radio audiences. We need to take you to the Techstars Leadership Forum. It's taking place here in London. Jamie Dimon, the J.P. Morgan Chase Chairman and CEO, is joined now by Bloomberg's Emily Chang. Emily, over to you.
Thank you. Welcome to our Bloomberg television and radio audiences. I'm here with JP Morgan CEO and Chair Jamie Dimon in London on the sidelines of the Techstars Leadership Forum. Jamie, thank you so much for joining us today.
Thrilled to be here.
So we just saw a few tech companies go public: Instacart, Arm, Klaviyo. Yep. What's happening in the markets? Are we back, or is this a blip?
I think it's open for now, for different types of companies. But you see IPO markets like an accordion. I think there were like 400 plus deals in 21 and 40 in 22, and I think something like 50 or 60 this year. Obviously, interest rates change a lot, how people value it, whether they want to go public, the value of cash flows, so earnings and cash counts a little bit more than it counted before. But for now, it's open. Markets are healthy. The economy is still okay. So it's open. Maybe not for everybody, but it's open.
Given we're in London, you don't see the same wealth of tech companies that you see in Silicon Valley. They want more big star tech companies here. Why haven't we seen that?
Yeah, I think I look at it the other way around. U.S. was the center of tech, not just Silicon Valley. It's all over America. I recently came from, Boise and other places. It's staggering. But so the diaspora's actually moved overseas. You have I was recently in Berlin and Paris. There are tech startups everywhere now. They're quite good. They're more of going public. And we're the leader of taking them public here. So I think it's a great thing. And obviously you've always had it in China, a little bit in India. Still, it's not, in Europe, it's not quite like the United States, but the fact that it's here is a very good thing.
JP Morgan's tech footprint has gotten even bigger now that we've seen clients flood out of SVB. You bought First Republic. How big is the opportunity to be the new incumbent bank for startups and VCs? And how will you, Jamie Dimon, manage the risk differently?
Yeah. I think, first of all, we didn't want to benefit in the world by that kind of thing happening. So it wasn't good for banks or good for us. Having said that, when that happened, we had people working around the clock, literally, to open those accounts. I recently came from a Sequoia thing. I know a lot of the venture capitalists, Saturday, Sundays, through the nights to onboard these accounts and help them through it. And, one of the great, and we always were there. We always did okay. I always want to do better. We're adding people. I think the biggest difference in Silicon Valley Bank, before I get to First Republic, is they did a great job at some of the stuff. So obviously there's certain things they did on a macro level which weren't right. They did a lot of things at the micro level that were right. How they dealt with the client, how they serviced them, they serviced them locally. So we have unbelievable products and services to bring to them. Digital, consumer, subscription lines, financing, globality, research, you name it. But we have to deliver it to them in a way they actually like it and they want it, which is what Silicon Valley Bank did. So we're organizing around it. If you speak to a bunch of people here, you hear them talk about, we just took out a whole bunch of new space in Palo Alto. We hired John Chena, who's one of the top people out of Silicon Valley Bank. Organized around the innovation economy. We'll get it right. I just want to make sure they're happy with us a year from now, not just today.
But what about
we're already a leader.
Risk?
That's what we do all day long. It's not. It's for us. It's incremental risk. It's a slightly different kind of risk. So and this happened years ago. Would a bank lend to a non-revenue company? Well, the answer 20 years ago was zero. But we did Facebook. So we've learned how you can do that, when you do that. But again, the risk it's not the risk, it's the venture capital company, it's the venture capital partners, it's their investee companies, it's the investee companies' managements, it's that whole ecosystem, and so we're just organizing around it.
You've got a top-notch group investigating AI. What are they up to? What's the next level of finance you think AI can unlock?
Yeah, so I think the most important thing is that AI is real. We already have thousands of people doing it. Top scientists around the world, Manuel Velosa, who ran Carnegie Mellon Machine Learning. And it's a living, breathing thing. So people want to answer, what's it going to do? It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. Like, AI is doing all the equity hedging for us for the most part. It's idea generation. It's large language models. It's note-taking while you're talking to someone. And while it's taking notes, it may actually say to you that, here's the thing of interest the client might be interested in. All error, all customer service. It's a little bit of everything.
But it is going to replace some jobs.
Of course, yeah. But I look, folks, people have to take a deep breath, okay? Technology's always replaced jobs. Your children will live to 100 and not have cancer because of technology. And literally, they'll probably be working 3.5 days a week. So technology's done unbelievable things for mankind. But, planes crash, pharmaceuticals get misused. There are negatives. This one, the biggest negative in my view, is AI being used by bad people to do bad things. Think of cyber. Henry Kissinger talks about warfare. But the fact, and I do think eventually have legal guardrails around it. It's kind of hard to do because it's new, but it will add a huge value. And, for JP Morgan, if it replaces jobs, we hope to redeploy people. Like at First Republic, we've offered jobs to like 90% of the people, they accepted. But we also, we've told them some of those jobs are transitory, but we hire 30,000 people a year. Right. So we expect to be able to get them a job somewhere local in a different branch or a different function if we can do that. And we'll be doing that with any dislocation that takes place as a result of AI.
I want the Jamie Dimon forecast on the broader economy. Yeah. First it was hurricanes, and then it was storm clouds in your annual letter. What's the weather now? Is a recession
You guys have consistently got this wrong, okay? I'm not giving a forecast. I'm trying to, I blame myself, okay? The U.S. has been very strong for a while. No surprise, $5 trillion was pumped in fiscally, $3 trillion or $4 trillion of QE, and now that's being reversed. The consumer's still in good shape, they're still spending money, they still have more money than pre-COVID, it's spending down. Home prices have gone up for 15 years, asset prices have gone up for 15 years, they're in pretty good shape. And then the people are talking about deterioration. Credit is not deteriorating. Credit card all-time highs, not inflation adjusted or GDP adjusted or income adjusted. And yeah, it's deteriorating. We think it's normalizing. And corporate credit's been quite good. So you have a strong economy. That's the here and now. All the data is a little distorted because of COVID and things like that. When you ask the question about a forecast, and I don't make forecasts, I look out there and say, what are the range of outcomes?
From hurricane to storm clouds.
No, I put as several storm clouds. When I said hurricane, I was correcting. Someone said the storm clouds dissipate. I said, no, that one may be a hurricane. We don't know what it is. Here's what they are. There are two of them that are different than other things. So we always have, I don't worry about the weather, and I honestly don't spend a lot of time guessing about the economy. I mean, that to me is the sunny or rainy. I don't worry about that. We run the company to serve clients through thick and thin. That's what we do. To serve governments, to satisfy our regulators, and that's all weather. But there are two things which are extraordinary today, which may have different outcomes, and think of them as storm clouds. We don't know if they're going to hit, when they're going to hit, what they're going to do. Okay, so I'm not predicting that, but I'll tell you what I worry about. So one is the fiscal money being spent is so big, largest in peacetime ever, America and kind of around the world, with already very high deficits. And QT we've never had. So I know some people think QT will be uneventful. I'm not so sure. At a minimum, I expect volatile markets. And then you've got, and then all the long-term fiscal things are kind of inflationary. Oil prices, certain commodity prices, the green economy, the restructuring of trade, you name it, I see is adding to inflation, not subtracting inflation. So I don't think inflationary will be that, keep on coming down. It may not. And therefore, rates may go higher. But the biggest storm cloud is geopolitical. It's Ukraine, the humanitarian crisis. It's a war not far from here. It's along 600 miles, 500,000 people have been killed. It's nuclear blackmail. It's going to affect all global relationships in America and China, trade alliances. We don't know how it's going to start either. So I just put those two things as I keep a close eye on. And then how it affects the economy is different. And what I've been talking about that is I just tell people, be prepared for higher rates and slower growth.
7%. Are we really going there? And how does that
I don't know. When I said 5%,
growth?
They said, are we going there? Yeah, it's possible. So when I talk to my board, I say, yeah, can it go to 7%? The answer is yes. Are there factors that would drive it, higher than, where it is today? 4.5, 4.6, or 4.7, over the 10-year bond now. Yes. Is supply and demand could push it high? Yes. I'm just saying, be prepared for it.
So
and then the worst case is stagflation. Higher rates because you have a booming economy and there's a lot of competition for capital is not the same thing as stagflation.
What are the ripple effects of the stress of that 7% rates on business, on your growth?
Well, I'm not worried about JP Morgan. JP Morgan, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. That risk management is not the same thing as guessing the future. When risk management, looking at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in-between. If you bet your company on one outcome, so I think all companies do that. And every company's got different exposures, input prices, output prices. Some interest rates don't matter, some it's the price of mozzarella. So what's your business? Your business is different. So, but I think we don't know the effect of these things on the economy. So we may have a soft landing, we may have a mild recession, we may have a harder recession. Obviously there are potential bad outcomes. The worst one would be economically is stagflation,
right?
Where you have low growth, high interest rates, and obviously if that happens, you're going to see a lot of people struggling.
Where's China on the list of risks?
Oh, when I say geopolitical, that's the big one. It's the thread from Ukraine, oil and gas, food, migration, all our relationships. The most important one being China. That is the most important for the future of the world, and obviously Ukraine is affecting it. And in fact, it's very hard to see really positive outcomes with China until the Ukraine war is resolved. Hopefully, where the Ukrainians could say they have a victory of some sort.
You've said you're worried about another Trump presidency. How worried?
I don't know if I've said that. I'm hoping the American public, we need good American leadership. And I think that we need to explain to people why this is so important for the world. And so there's a little bit of this, America first, and, no American president is going to say America second. But what we need to explain is why Ukraine is important to us, and why American security relies on global security, and why our allies rely on that. And if they can't rely on America, they will have to rely on someone else. And so I just think it's very important. Bob Gates writes in his book, The Exercise of Power, about the symphony of power. And all the soft things, not the military, which we've overused, but diplomacy, development finance, education, communication, and obviously economic, trade, investment, all those things. And I think we need to do a better job in that.
We just avoided another U.S. government shutdown. Now there's talks of a McCarthy ouster. Do you have a message for anyone in Congress?
Look, we need good policymakers. A shutdown is a bad idea. I'm grateful they came up with a solution. Democracies, by their nature, mean compromise. That's what a democracy is. So and there are a lot, when I go to Washington, you see on the press all the time the bad parts. There are also some great Congress folks, great senators who want to get things done in the interest of the United States. And I'm glad they did this particular one. Of course, 40 days, 45 days from now. And, Kevin McCarthy is the Speaker of the House, and I wish him the best. I've known him for many years, and he's got a tough hand. He's got a tough hand, but he's doing okay so far.
Regulators have proposed new capital rules that banks have said will make it tougher for Americans to get a mortgage. But I'm curious, when you look across the firm, what businesses are going to have the biggest impact? Break it down.
First of all, it's 1,000 pages long. So you have to go by product, by service, by country, by cross-border, by type. And then there's operational risk thing. So, I don't think it's all the right stuff. I don't think it's very comprehensive or well thought through. But let them do what they want at this point. And nor is it international. So you may not know, if you're an American, we have to have 30% more capital than European banks, the way it's currently constructed. What happened to the international requirements? Like, weren't we supposed to international level playing fields and all stuff like that? When you get into the specifics, it really matters how the ultimate rules about mortgages and small business loans, et cetera. In general, it makes, what I don't like about it, for example, it punishes diversification, operating risk capital, and GSIFI. And diversification is one of the true free lunches for a bank that protects it. And I don't understand why they do that. And I just, we're going to be responding. Hopefully it'll be modified and thoughtfully done for international purposes. And mostly, America's got the best financial system the world's ever seen. And, that includes hedge funds and private equity and private capital, all things like that. But this is, I say that private equity hedge funds are dancing in the streets. And this time they're being quite public about it, because this is going to push a lot of stuff out of the banking system. And if that's what the regulators want, so be it. Is that good for America? I don't know. We've gone from 7,300 public companies in 1996 to 4,500 today. Is that what we wanted? It should have been 14,000. Did you want a lot of credit to move private? Maybe they did, and then they accomplished their goals.
The biggest tech companies prop up a huge chunk of the S&P. Is big tech too big to fail?
I think that's a too broad a question. I think in any industry, well, you say too big to fail, which I've lost touch with what that really means anymore, because remember, car companies were bailed out, and these things were bailed out, and I don't understand. They should ask what they want. If the regulators don't want a bank to ever fail again, then we should do A, B, C, D, and E. If that's the goal. I didn't think that was the goal. I think Dodd-Frank actually accomplished most of the goals, which is dramatically reduce the risk, create liquidity, capital, stuff like that. So, and big tech, you got to be very specific. Sometimes companies misuse their position, and sometimes they don't. Sometimes regulators capture it, sometimes they don't. but they're powerful, and we have to deal with that. I've been writing about, big tech going to our business. We got fintech, but we also have big tech, and they will embed payment systems in there. Some are going to white label banks, kind of what Apple did. They have the right to do that. I'm not against that. I would be against unfair use of their position to dominate us in a business.
Well, Apple is going deeper into financial services. Do you worry about the Bank of Apple?
I wrote about it. I wrote about it like 5 years ago.
Well, how worried are you now?
Like, what is a bank? Well, we're going to compete. So they have a tough competitor, but they hold money, move money. You could put money in basically markets, but it's a white labeled checking account, credit card, all these things. Yeah, they're a form of a competitor. We also partner with them, but I'm very used to partnering and competing with lots of people.
Existential threat?
I don't think it's an existential threat, but I think if we were complacent about it, yes.
Jamie Dimon, we're here to talk about tech. I'll see you on stage. Jamie Dimon, Chair and CEO of JP Morgan. Thank you.
And that was Jamie Dimon, along with Bloomberg's Emily Chang. From London, live at the Techstars Forum, I'm John Tucker, along with Bailey Lipschultz today. Matt and Paul are both out. Let's get some more reaction to the interview with Allison Williams, who covers the banking industry for Bloomberg Intelligence. Risk management, Allison, encompasses a range of outcomes. What does he sound most worried about to you, and can a bank like that handle it?
Well, I think that's his bottom line, right? Is that, risk management is the business of banks, and they are prepared for various scenarios. He's been saying for some time now that the world might not be prepared for higher rates. That rate seems to kind of inch up, and perhaps he's just sort of marking to market that statement, but I think it does sort of perk people up. First it was perhaps 6%, so now it's 7%, but I think his bottom line is that the bank is prepared for it. And what's interesting is you heard him talk about sort of a range of different risks, right? So there is the risk of higher interest rates. He discussed the risks of, I guess the fallout of fiscal spending. Certainly fiscal spending is beneficial to the economy in the near term, but what are the longer term implications of this unprecedented spending, which is, the key thing that we worry about as well. And then competitive implications. And, I think his ending comment about the fact that, the banks have competitors that they work with, that they compete with, and it's important to take advantage of opportunities across the landscape and the ability to work with people, but also important to invest in your business. And I think that's what really has helped JP Morgan come out ahead.
Yeah, Allison, Jamie Dimon talking about we might go to 7%. Is there a point where that becomes more of a concern for certain banks within your coverage as opposed to, a JP Morgan?
I think in general, there was definitely a wake-up call back in March. It was, again, it comes down to risk management. It did end up costing a couple of banks their lives. And I think it was a wake-up call to the rest of the industry to really focus on, getting those exposures more in line. Obviously, there's also the government help that's a part of it. So I think that, in the nearest term, the issue really relates to funding costs because banks have gotten this big benefit from higher rates. And the higher, as those rates start feeding into their funding costs, which is sort of their cost of goods sold, the margins are expected to narrow over the next year. Now, there's been in the past few months, I feel like some alleviation of those worries, especially from what we're hearing from banks, what we're seeing on deposit costs. But some of the price action that we've seen in bonds signal that there could be some complacency. So I think that'll go back and forth. I think, that higher rates, if we went back, decades and decades ago, generally are bad for banks because we were in such a period of extended low rates. that was sort of even worse because there was nothing that the banks could do with their funding costs. And now I think we're just going more towards a normalized environment.
Hey, Allison, in our next lives, Bailey and I are going to go into private credit and make some real money. What's the landscape there as it pertains to JP Morgan Chase and Jamie Dimon? Are they enemies, frenemies, or what?
Well, in general, private credit is really the transfer. I mean, by definition, right? Like, so it's sort of the credit assets, if you will. If you look back over, like, say, the last 20 years or so, the migration of those credit assets has been away from banks and to public sources, right? So mutual funds and the like. And now, as you point out, it's, private credit is all the rage. Private equity, we know, has delivered very good returns over the long term. And that is why a lot of money has continued to go into that asset class. And now I think we're seeing the same thing with private credit, just in terms of better returns over time. The one thing that we're always watching is, a famous investor said, there's no business that an oversupply of money can't come in and ruin. So I think that's what we're watching on the private credit front.
Yeah, and one of the things that stood out to me, Jamie Dimon talking about essentially not being so sure that quantitative tightening will be uneventful. Is that inherently more of a risk for different banks within your coverage, or how do you kind of view the impacts of QT?
I mean, I would say that, this is unprecedented, right? So there's no, we've had unprecedented stimulus. And so that unwinding of that is something we've never seen happen. So, certainly our view is that, unexpected things can happen because we are in new territory. And that, again, just highlights, back to the beginning of our discussion, risk management, right? So you need to prepare for all types of scenarios, and including long tail scenarios that have a small probability of happening, but could be financially tough.
Allison, always a pleasure. Appreciate it. Allison Williams joining us from our Princeton Bureau. Allison, Bloomberg Intelligence, with the interview with Jamie Dimon and Bloomberg's Emily Cheng, the reaction there. Let's turn our focus more to the markets right now. S&P 500, 2 points higher. The Dow down 58. The NASDAQ 100 right now, 92 points higher. And for the outlook for markets in the U.S. and globally, can the U.S. avoid recession? Let's head to our next guest right now. Nancy Curtin, a partner, global CEO, the head of investment advisory at Quantitative Global. Thanks for being with us today. Appreciate it. You heard Jamie Dimon there mention what they could handle 7 to 8% rates. The 10-year at 4.65. That would appear to be at least partially in the driver's seat for equities. What is your outlook for rates and the impact on the risk assets?
Well, look, near term, we're a bit cautious here. And we said declines at the end of July, that trees don't grow into the skies. After 20% total return of the S&P 500, we needed a pullback, a correction, a consolidation, okay? But if we look at the fundamentals, the reason that we have near-term caution is what I call sort of a litany of triple woes. The first is the higher rates that Jamie mentioned and that you've mentioned in your program. These higher rates are coming at the long end. That sets the cost of capital for companies. So that's going higher. In part, maybe it's about a long-term view on structural inflation. It's also about a rising term premium. I think investors getting to grips with the size of the fiscal deficit. So, higher interest costs for companies and borrowers. You also have higher oil, and that's a tax on the consumer. And finally, you have a higher dollar, and dollar's up about 7% from the July low. So I put those three things together. I've got a higher cost of capital, I got a tax on the consumer, and I've got global tightening. So we do expect growth to slow in the United States in particular. But by the way, that's no bad thing The third quarter in the United States, growth has been accelerating here. Whether the number comes in at 3% or 3.5% or 2.6%, it's going to be higher than the second quarter. And we do think it's important that growth slows. And